Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. The race for artificial intelligence supremacy.
DeepSeek really rattling. It feels like every part of that supply chain.
A shifting business landscape in China. Disruptions in global trade. And an unpredictable Trump administration.
The golden age of America has officially begun.
The world is changing at lightning speed. We'll look across public and private assets, crypto and wealth management, deal-making and capital demands to find out where the risks and opportunities lie. Bloomberg is here to track, dissect, and navigate the markets alongside the industry's most influential voices. This is Bloomberg Invest.
Please welcome to the stage Bloomberg's Shonali Basak and David Ingles.
Good morning to everyone. A very warm welcome for those of you who have been in Hong Kong for a few days. Warm means quite literally the weather out there. We understand why. There's a typhoon, of course, that's perhaps upon us. But in any case, of course, that's not going to ruin our party. Welcome to Bloomberg Invest here in Hong Kong. And joining us here live all the way from New York is my colleague, Shonali Basak.
David, it's so nice to meet you only a half an hour ago,
Yes.
but I wake up to your market analysis every single morning, so really a joy. And this city has been so electric, and I'm thrilled to be here. There are hundreds of people joining us here in Hong Kong, but also even more from all four corners of the globe virtually. And we hope you'll also join us on social media. David and I are both very active there. It's hashtag Bloomberg Invest for wherever you like to be on social media. Now, you can engage with us, look at the agenda, submit questions to our speakers. We like to look at those. We like to see what you want to know about, and you can participate in polling using the QR code that it will be on the screen. And also, we would like to take a moment to acknowledge our title sponsor, Invesco QQQ, and our presenting sponsor, Standard Chartered. And, you know, so much happening today and this year. When we had Bloomberg Invest in New York, it was in early March, where the tariff story was very different.
Yes. Well, we were anticipating something happening. Things happened. And then there was 3 months in between. And then just news this morning, and we'll talk more about this later, that the two sides, the US and China, have agreed to a framework of how to move things forward. And I think really that colors most of the conversations, among the many other things, of course, we'll talk about.
Yeah, we'll talk about the entire region. We'll talk about demand for assets across Asia.
Right.
And that US dollar, of course, bond sale tomorrow. That will be hotly contested, of course.
The 30-year auction.
The 30-year auction. We like to keep an eye on everything macro and micro. But David, you have a big conversation coming up,
Yep.
so I will leave it to you.
Okay, I'll see you later.
I'll see you later.
Okay. So in a couple of minutes, we'll be having Hong Kong's Financial Secretary, Paul Chan.
Our role is super connector and super value adder. So in terms of super connector, connecting the mainland capital market with the advanced economies, US, Europe, and further expanding it to global south emerging economies.
So the GBA alone, Greater Bay Area, 87 million people. The aggregate GDP is the size of Italy, $2 trillion US. So this is huge consumer market.
Pretty cool, right? Pretty cool. So we're doing things a little bit different today before we actually dive into the conversation here with the Financial Secretary. As you can see, my co-anchor, for those of you who follow the China show, Yvonne Man, is in fact right outside. We're bringing the show on the road, and she's here, of course, as you can see here, just to really get set up. And I think they're about to start the show in a couple of minutes, so I think she's about to say some things. There we go.
Dominating headlines today. We're half an hour from the opens in Hong Kong, Shenzhen, and Shanghai. I'm Yvonne Man. You're watching a special edition of the China Show. We're bringing it to you live from Bloomberg Invest Hong Kong. The top stories this morning, the U.S. and China moving to ease tensions with a new plan to implement the Geneva deal, now heading for approval from Presidents Trump and Xi. Markets reacting cautiously with few concrete details out of the London talks so far, but the U.S. side says it expects issues around rare earth minerals will be resolved. Meanwhile, we'll get reaction from our big-name guests here at Bloomberg Invest Hong Kong, including the city's finance secretary, Paul Chan, joining us live in just a moment.
There we go. Yvonne, thank you so much for that. And yeah, we're going to get underway on the show outside. Every now and then, I'm not checking my messages or WhatsApp. I just have to look every now and then back at my phone to just get a sense of what's happening. This is we're trying to balance this gymnastics between a live show and a live show here on stage. But again, here with us on...
So nothing to do with the typhoon, right?
Nothing. Well, unless we get to T8. But I know, of course, the Hong Kong Exchange has now some new rules in place that allows trading to take place in the event of extreme weather. But I guess let me start off with, Mr. Secretary, my co-anchor just mentioned the news this morning.
Yeah.
The two sides encouragingly have agreed to a framework to move things forward on trade talks. I'm curious what assumptions the Hong Kong government is making around what happens with the trade talks and you know, as you try and plan what to do with the economy in case the worst case scenario happens.
Well, you know, the outcome is somewhat expected, but there are bound to be volatility, ups and downs. So we won't underestimate the challenge. For us in Hong Kong, concentrate on doing the right thing. On the one hand, ensuring financial security, financial stability, and on the other hand, in terms of international financial center status, in terms of our trading hub status, as well as a rising technology and innovation hub, we concentrate on these three fronts to move forward to drive our economy to continue to grow.
What are your expectations for the economy this and next year?
This year, the estimate GDP growth is 2 to 3%, as indicated in the budget. The first quarter performance was impressive, 3.1% growth. Export strong. Private consumption a little weak comparatively, given the changing spending patterns of Hong Kong residents and incoming visitors. This is understandable, and we help the industry to transform, to reinvent themselves to respond to this change. This will take a little time. Investment also sustained. Into April and May, the figures currently available, exports still holding up, investment still quite good, stock market is doing quite well, and the pipeline is strong. So we expect this year the stock market will continue to be strong, and this will give support even to private consumption.
Right. The wealth effect, as they say, in fact, quite timely. It's almost like we planned it yesterday at the close. The Hong Kong stock market, specifically the Hang Seng China Enterprises Index, actually entered a bull market as of the close yesterday. It's almost like we planned it. We'll just say we planned it. We'll just say we planned it. On the market side of things, you know, one of the big highlights this year has been the return of big listings.
Yep.
In Hong Kong, we have had a massive one, CATL.
Yep.
A few weeks ago. Just give us a sense of what's in the pipeline.
Well, you know, CATL is a classic example, drawing a lot of attention, and also, you know, the deep-sea moment, causing the foreign investors to reassess, number one, the technical capabilities and innovations on the mainland and the possible investment options. Number two, people find that perhaps earlier on, last year, say, for example, they had underweight their allocation to this part of the world. So you saw funds flooding in. We have looked at the IPO pipeline, very strong. On the one hand, given the geopolitics, it is getting more difficult for tech stocks, say for example, to go to the US for listing. Then if they sit for international listing, Hong Kong is natural destination. And also, as you mentioned, the return of the China concept stocks. I've already asked my colleagues in the Securities and Futures Commission and the Stock Exchange to get well prepared for them to come back to facilitate this listing.
Should we expect more big listings this year?
More to come, actually, more to come. The pipeline is very strong, and also the central authorities are very supportive of this move, encouraging the mainland major companies coming to Hong Kong for listing.
For, I guess, those who, I cover the story every day, and almost every day it still surprises me that big name after big name either files an application or gets approved from for an application. If you could give maybe some in the audience who might not be too familiar, why are we here? Why are central authorities encouraging more listings to come to Hong Kong? What's the background?
Well, you know, number one, for China's development strategy, they talk about domestic circulation, meaning stimulate domestic consumptions, domestic consumption-driven kind of growth, given their vast market, huge population, and the aspiration for better goods and services. This is one. Number two, they are also encouraging mainland companies to go global. There is also a saying, you either go out or you are out of business. So you can see mainland companies are getting very interested to go global. And there is also commercial justifications. You talk about the capacities on the mainland, say for example, if they're able to diversify their industry chain outside of the mainland, say for example in Global South, in particular Southeast Asia, that will help address certain of the capacity issue. And also this is the rising market, very familiar with the Chinese culture and custom. And the Chinese people are doing business there for a long time. So this outbound of mainland companies, this is a trend, unstoppable. And I think this is good also for the region, because by realigning their industry chain, their supply chain, they will also stimulate the growth of the region. And Asia, as you know, particularly this part of Asia, is a major global engine for growth. And given the Chinese economy growing steadily on a sustained basis, also become a stabilizer in terms of the current, sometimes pretty uncertain and volatile global market.
Stephen Roach, former, and there's a smile already because for those of you who might have seen it, had a very, Stephen Roach, the former chairman of Morgan Stanley Asia, I think it was June of last year, made this fairly bold call that they said Hong Kong was over. A few weeks ago, in fact, about a week and a half ago, he somewhat changed his tune and said it's too early to call Hong Kong being over. In fact, he came on the show and explained why he had a change of, somewhat of a change of mind. And one of the things he said was he didn't expect Hong Kong to benefit from a listing standpoint, to benefit from this rift that's taking place between China and the U.S. Is that, would you agree that Hong Kong has somewhat benefited from all the uncertainty out there?
Well, you know, Hong Kong people are very agile and very adaptive to changes. I think the circumstances are bound to change, both external, on the global front, often also in this region. The question for us is to try to identify the mega trends. Say, for example, currently it is the geopolitics, the green transition, the digital economy, and then redefine ourselves, get our positioning right, and concentrate to do the right thing, and leverage on our uniqueness and the competitive advantage. I think our uniqueness and competitive advantage is under the one country, two system. Hong Kong is still the platform for the mainland to interact with the international investors. I think our opportunities is not just financial services. Say, for example, talents, the return of overseas Chinese talents, the coming of international expatriate talents. Hong Kong has been attracting a lot. Since we launched the scheme to attract talents at the end of December 2022, up till now, we received over 460,000 applications. We approved 213,000 of them, and about 118,000 already arrived. And more are coming. That is one. And also technology, artificial intelligence, for example. For artificial intelligence companies on the mainland, if they want to go global, well, they need data. They need because for the AI industry, this is core. Where can they get the international data? It is Hong Kong. For biotech companies, for drug development companies, if they are interested, say for example, European or American drug companies, if they are interested in the mainland market, where can they get the biosamples? Where can they do the clinical trials? Where can they do the expedited drug and medical device registrations and get those to be sold on the mainland and at the same time overseas? Hong Kong is the answer because, for example, we have the approval with the central authority in the Lok Ma Chau Road on the border of Hong Kong and Shenzhen. We will set up those facilities, and the mainland regulatory authorities will set up a branch approval authority there to expedite the approval process. So the opportunities, I think, is tremendous. It is how we position ourselves and how are we trying to gather the critical success factor together in Hong Kong.
You know, that's a very good point you bring up. The three industries that immediately come to mind when I think about Hong Kong is finance, legal, and property. In a couple of years' time, to your point, some of the structural shifts, what do you think will be the dominant industries and sectors in Hong Kong, given the mega trends that you just outlined?
I think going forward, well, although as you know, in the 14th five-year plan, we are given 8 centers status. These are the development directions. But to me, I think the key drivers would be financial services, trading, technology, and innovation. These are the 3 drivers in terms of contribution to the GDP. Although the innovation and technology sector will take some time, but interestingly, these few sectors are interrelated. If we want to be successful in the technology sector, our selling point, apart from the international dimension, the availability of international talent and data, is our full range of funding options for tech companies. No matter you are a startup or at different stages of development, you need angel investors or VCs, or you want to go IPO and then to do the subsequent round of funding. Hong Kong offers this full range. And this is operating on common law. We practice three spoken language, two written, including Chinese language. And this is an environment very familiar and trusted, both by international investors and our mainland counterparts.
I just thought about the other point that Stephen Roach brought up in our interview we did about a week ago. He said, when you look at the number of listings in Hong Kong, or at least the list of listings, the dominant theme is these are mainland companies listed here.
True, yeah.
Does Hong Kong need to do more to attract non-mainland companies? Is Hong Kong open to companies from all over, including the United States, to list and raise money here?
Yeah, the current situation is natural because we are part of China. Mainland companies are rising so fast, they want to go global. But we do want to attract more companies from overseas to come to Hong Kong for listing. In the recent years, as you know, the chief executive, myself, and my other policy secretaries, we travel a lot to Southeast Asia, Middle East, for example. Even went to Europe. We want them to come because this is an open platform for all. And we do believe international collaboration, leveraging to our respective competitive advantage is the answer to counter the unilateralism and to promote shared prosperity.
You mentioned the Middle East. We've been waiting for one big company that has been speculated to maybe look at, I don't need to mention the name of the company, 5 letters, 6 letters. Yeah. Do we eventually see a big Middle East energy company list in Hong Kong at some point?
There are many other good companies.
Okay.
Indeed, yeah. and indeed, interestingly, even for Saudi Arabia, say for example.
I didn't mention Saudi Arabia, but okay.
Indeed, the Gulf area as a whole, what they are looking for at the moment is not just outbound investment. They are very keen also for inbound investments. And in particular, business in this region, in Hong Kong, in GBA, on the mainland, to go there to set up manufacturing facilities, to work together with them in terms of the real economy, because they also, say for example, in Saudi, they have the Saudi 2030 vision, diversification of the economic structure. And I think this is a strategy pursued by all the Gulf companies. So our collaboration with them are multi-level and multi-fund. And we are seeing more mainland companies in this region, in Shanghai, Zhejiang, Jiangsu, going there as well. And there are companies coming.
Okay. I need to ask you about, we have about 5 minutes left, about the recent weakness in the US dollar. We can talk about the peg in a moment, but I just want to get your thoughts on what are the major implications for Hong Kong of a weakening US dollar? Does that in any way change, say, the way you look to construct your reserves? And what are the other major implications that might have?
Well, Hong Kong become a safe harbor for this international capital because our dollar is pegged to the US dollar. Since 1983, it has been functioning very well. We don't have exchange control. Capital coming in, going out anytime. We ensure that is continue the case. And this is our very solemn commitment. And this is also our competitive advantage. And for us, income coming in, going out can be very abrupt, very sudden. So ensure financial security stability is number one. Number two, at the moment, well, with this influx of capital, interest rate is indeed very low. Good for our homeowners and good for business as well. So I think put the CBL on, but at the same time, take advantage of this ample liquidity.
You bring up a very good point. One of the big stories, in case some of you missed it, in Hong Kong recently was the drop in HIBOR, to which a lot of mortgages are tied. The drop from, I think it was north of 4 or 5%. Last I checked, we were at 0.5%. Is the preference for HIBOR to remain low?
Well, this is market behavior.
Okay.
So we won't interfere, but well, the current low interest rate is welcome.
Okay.
Yeah.
Well, let me rephrase it. Is the objective in some ways, because you have sort of control over liquidity in Hong Kong, which somewhat affects HIBOR, for example. Is the objective largely to keep HIBOR and interest rates low within the peg system, of course?
Yeah. We believe in market force. We believe in market force, and we do not want to send any signal to the market to cause any misinterpretation about the government's intervention into the peg. So we believe in the market.
And the peg stays?
Of course. No.
Well, tell us why, because a lot of people over the years have called for the peg to be rethought. Why does it not make sense to rethink the peg?
As you know, we are a small, open economy, international financial center. So it is important for us to hold to our core competitive advantage. That is open market, capital coming in, going out freely anytime at a stable, predictable exchange rate with predictable, transparent, and consistent government policies. This is the core. We don't want to allow any misinterpretation of this. I think we went through many cycles and ups and downs in the market since '83, the implementation of this system. It has been functioning well. At different times, different sectors of the economy may have complained, but overall, for Hong Kong, it's a good thing.
Very quickly, you oversee the budget as well. Just a final question on that. Next few years, we've had some constraints around financing because of what's been happening since 2019. We've had COVID, for example. What's the government's target in terms of balancing the budget? And just give us a sense of how you're thinking about the finances here.
Yeah, great, thank you. We must distinguish government budget into two major components. One is operating account, daily income, expenditure. All the taxes go there except land revenue. And the other is the capital account. The major income is land related. And the capital account is for capital investment, infrastructure investments. We believe the management of these components, the philosophy is different. For the operating account, we need to seek to balance, and not just balance, to register a surplus, to give us the room to invest in more capital works, invest into the future. So this year, 25-26, the operating account will be break even. And then on, we'll register surpluses. For the capital account, as you know, we want to expedite the development of the Northern Metropolis, because there is where we will house the technology and innovation sector. The companies we attract, we don't want to settle them there. We want them not just use Hong Kong as an office, but set up your research, set up your manufacturing, particularly advanced manufacturing facilities there. So we needed to have the land. So for the capital account, the annual capital works expenditure will be increased from 90 billion a year to 120 billion a year in the coming 5 years. So it will be a deficit in the capital account. How do we finance this capital account deficit? Make use of the market resources. Public-private partnership is one, issuing some bonds is two, and in terms of bond issuance, our borrowing ratio is so low. By any standard, there's room for us appropriately to issue some bonds to finance the capital works, and also consider to issue some long-tenor bonds, with 20, 30 years. So these are all the financial tools available to the government to manage our books. And in fact, the rating agencies has reaffirmed the rating of Hong Kong, also the stable prospect of Hong Kong economy, and also acknowledge that our policy making in terms of the financial area is flexible and appropriate.
Mr. Financial Secretary, we have just about a minute left. There's a live audience here. There's a live audience, global financial community watching us live. Any last final message?
To our friends from overseas, I would invite you to come to Hong Kong. A lot of events going on, arts, sports, and also come here to see how vibrant this area is. And not just Hong Kong, but also taking the opportunity to visit the Greater Bay Area. That will give you more understanding of the opportunities. Thank you.
Right on time. Thank you so much, Paul Chan, Hong Kong's Financial Secretary.
Yeah, thanks.
Thank you so much. Thanks.
Please welcome to the stage Xiao Liu, Dean and Professor of Finance, Guanghua School of Management at Peking University, for a conversation with Bloomberg's John Liu.
Good morning. Excuse me. Good morning, everybody. So I think the item that is probably on everybody's minds this morning is what was the consensus reached in London about Geneva? And I don't have any inside information. Do you have?
No, I don't have inside information.
So neither of us know exactly. We don't have any inside details. We don't know any more than any of you know. But I think we're in great luck today because Professor Liu Chia can help us do something that is extremely valuable as we try to figure out where we are and where we're going when it comes to trade tensions between the United States and China. And that's because Professor Liu is not only the dean of one of China's most prestigious business schools, he's also on the expert committee that is helping to draft the 15th five-year plan, which will cover 26 through 2030. Right? So what I'm hoping we can discuss and help everybody with is understanding what is the Chinese perspective on what's going on right now in the world. And so, number one, any government in the world is looking to produce growth for its population economically. Chinese growth has moderated recently. There's been comparisons about, is China going the way of Japan? Is this peak China? What is the Chinese plan for continuing the economic growth that we've seen over the last 3 decades? And what is the biggest challenge to that happening?
Yeah, I think definitely we're seeing economic slowdown in the past decade or so. I think one of the major reasons is that the total factor productivity goals has declined. China basically accomplished industrialization process back in 2010. So manufacturing sector actually share of GDP is declining. So when you have a large manufacturing sector, when you have mass production opportunities, it's easy to have faster growth. But right now, I think the service sector is accounting for more than 56, almost 57% of GDP. And when your service sector dominates, the growth rate will tend to decline a little bit. I think we have observed this trend in US, in most of the industrialized economies in the past. I think right now China is getting into that phase. So I think to boost economic growth, basically you have to rely on TFP goals. TFP basically means total factor productivity goals. I think right now the growth rate of TFP in China has been somewhere around 1.5% to 1.8%.
Can I just stop you? So TFP, total factor productivity. So when you move a farmer into a factory and you give them a new piece of equipment, that increases productivity very quickly. Yeah. But if they're a DD driver, it's very hard to increase their productivity.
Yeah, if it's a labor-intensive sectors, it's really hard to improve labor productivity or total factor productivity. That's correct. Yes. So right now, China, I think TFP growth rate has been declined to somewhere around 1.5, 1.8%. And typically, I think TFP growth rate accounted for about 40% of GDP growth. So if you have a 2% of TFP growth rate, basically you can maintain 5% of GDP growth rate. That is more or less the rule of thumb. So in China's case, it's very important to further boost TFP growth rate from current 1.5% per year to 2% per year. So this is how this new term, new quality productive force, is coined, because the essential nature of new quality productive force is to boost TFP growth rate.
But does that mean that the future of China's economy still has to be very largely based on manufacturing? Does that mean manufacturing still has to be the core?
No, I don't. I think if you have a large manufacturing sector, it's going to help. I think if you compare China with US, right now, I think manufacturing sector only accounts for less than 10% of US economy. But in China, this number is 26, 27%. So I think that definitely is a plus. But I think the TFP growth rate comes from different sources. So number one, technological progress. So if you have scientific or technological driven innovation, which can convert into like new industries, future industries, that can bring some growth on TFP. I think the other source is the improvement of allocation efficiency. So China, you have a lot of areas, strategic industries, in which, because of institutional distortions, what kind of reasons, I think the TFP growth rate has been constrained to a certain extent. So if you unleash those potential, you can still improve TFP growth. So you don't have to rely on a very large, oversized manufacturing sector. That is a plus, but not necessary. Yeah.
When you say misallocation and distortions, are you saying there are some areas of the economy where regulation is suppressing productivity growth?
Yeah, sure. I think in many areas. I can give you 2 examples. Number one, agriculture, right? I think agriculture actually right now in China only accounts for 7% of GDP. But if you look at the labor force, I think more than 22% of labor force are in agriculture sector. So that is a sign of poor productivity. Why you have such situation? I think you have to think about the land system, and also the rural immigrants. It's really hard for them to fully settle down in the cities. So you have hukou system. I think those distortions have to be removed in coming years, and that will help facilitate the productivity growth in agriculture sector. I think another example is the finance sector. Yeah. So financial services is very expensive in China due to all kinds of reasons. So if you open up competition in those areas, I think that will improve the allocative efficiency. That can also help improve productivity growth. Yeah.
So over the next 5 years,
yeah,
your expectation would be for deregulation, reform in areas such as hukou, internal migration, in financial services, anywhere else?
I think that those reform measures have been laid out in the third plenary session of the 20th Party Congress last year, last July. And yes, you're right. Supposedly they should be complete by 2029, before the end of the 15th 5-year plan. So we'll see. Yeah, I think that could be launched gradually. Yeah, one by one. Yeah.
The other part of that for increasing productivity is technological innovation. What does the government do to increase the possibility of technological innovation? How does the government feel that?
Yeah, so I think this is why I think the sentiments about the Chinese economy all of a sudden have changed a bit this year because of 2 things, right? Number one, I think DeepSeek. I went to US in March. I talked to a lot of economists and also people working in the think tanks. Everybody's talking about DeepSeek. So I think that is a sign which showing that the foundation of Chinese economy actually is shifting. So I think AI and the big data-driven transformation is going to become one of the major parts of economic growth going forward. And the government has been, I think, promoting that. So in China, you're talking about the digital transformation everywhere. You're talking about the digital economy everywhere. Even in our schools, right, we have the new major, the management economics of digital economy. I think the demand for talents in those areas is huge. So I think that is something China is hoping for, because you can argue that AI and big data, they are general purpose technology. So they have a huge number of application scenarios. So if they can be applied and they can change current industries, or can somehow create some new industries, that is going to be a big boost for TFP growth going forward. I think that is one story. Another story I think people have talked about is climate change. People just argue that climate change actually is a constraint, but I think it's also about investment. For example, we have this estimation: if China, the whole world, wants to achieve zero net emission by 2050, I think beginning 2030, the total investment per year for that purpose is going to be somewhere around $10 trillion US. $10 trillion US.
10 trillion US dollars a year.
In China's case, I think because China actually has 30% of greenhouse gas emissions. So if we argue that China is going to shoulder 30% of such investment, it's going to be $3 trillion US, okay, which is 22 trillion RMB per year. And that is going to become a major drive of your mass production opportunity scenarios, and also technological progress, and also big boost for TIP goals.
How quickly do you think China will get to a point where it's investing $3 trillion US a year in the energy transition?
I think right now, in terms of the allocation of resources in the area associated with climate change, China has done a lot. You talk about EV, right? That's one example. And talk about the new energies. I think China has done a lot of investment. So I think going forward, I think further opportunities will come up, and the government has very carefully drafted plan to ensure that the investment will be there. Yeah.
So how does the trade relationship between the United States and China fit into this picture?
So I think probably this is my personal view. Is basically different from a lot of economists' perspective on this issue. I don't think it's a trade issue. I think it's a competition on TIP growth rate. Okay. As I said, in China's case, the TIP growth rate has been declined from 4% per year to 1.5% per year. But in U.S., I think right now is only like 0.7%.
0.7.
Less than 1%. The reason is very simple. You do not have mass production scenarios in the U.S. anymore. Manufacturing sector only accounted for, I think last year it was 9.98% of GDP. So this is why I think this is the whole idea of MAGA is about.
MAGA.
MAGA, yeah, whatever, yeah. You want to have manufacturing sector back to U.S. This is why J.D. Vance, in my understanding, was picked as the vice president, because there is a book about the Rusty Belt situation in the U.S. This is why President Trump actually, several days after he took office, he announced this huge project, Stargate, which cost $500 billion US. It's all about investment. It's all about TIP goals. You need investment to boost TIP growth rate. So I think this goes back to the reciprocal tariff, right? I think the Secretary Scott Bessent says that U.S. is going to win the war because they have market. Yeah. They want to achieve market decoupling. So this is why I think it's all about having manufacturing back to U.S. and it's all about TIP goals, competition. Yeah.
Do you think if it's not about trade and it's about getting manufacturing back into the United States and getting investment into the United States, is there a role for China in doing that? Is that something that, could China build factories, invest in the US? Is that something you think would?
I think manufacturing is just one source. I said one source of TIP goals going forward. US needs to work hard, think hard about the potential source of future economic growth. I think investment in manufacturing sector, having a massive amount of investment in certain area, for example, AI, computing power whatsoever, that is one choice. In China's case, I think we're working on the same thing, right? Because we're also facing declining TIP goals. So this is why we emphasize digital economy. We emphasize carbon neutrality. We talk about investment in public services, investment in human capital. We'll talk about those things. We hope that by making a larger amount of investment going forward, China can still maintain a moderate rate of TIP goals. Yeah. And eventually, the 5% or maybe slightly below that can be achieved in coming years. Yeah.
So if what the U.S. wants is manufacturing back in the United States, what does China want out of a deal? Is it mostly about technology, or is it also about access, market access?
I cannot say that the U.S. wants to have manufacturing back because it's almost impossible.
Okay.
I want to say that they want to find a way to shorten the gap between the growth rate of TFP between China and the US.
Okay.
So you have two ways to do that. One, increase our own TFP growth. The other way, contain the other side's TFP growth. So I think they're using both right now. It's a mixed strategy. Yeah.
So what does China want out of a deal?
China wants to boost the TFP growth. So China wants to emphasize scientific research and the technological progress. And China wants to maintain large-scale investment opportunities. So this is why China is very keen on green development, digital transformation, new infrastructure investment, etc. Yeah.
So we just have about 2 minutes left.
Yeah.
Do you see a way forward in which the United States, the relationship between these two countries becomes more constructive as opposed to competitive? Or do you think there's not much to change in that relationship?
But this is actually, I think, a very weird situation right now. Unless I think the U.S. is accepting one of the facts that China is catching up on almost every aspect. You have to, find a peace with rising power, which has different culture, different value with you. So before you learn how to accept that, I think the competition probably will escalate on certain front. Yeah. On the TFP front, on economic front, I would say that. In terms of politics, I don't know. I don't want to be comment on that.
But that sounds like you're saying it'll get worse before it gets better, and it would suggest you're not that optimistic about the near term. Is that?
I use a term. I think the word is getting into fragmented. The idea is that you can see that the second largest power is quickly catching up.
Yeah.
So I think right now China's GDP is 2/3 of US GDP. And people argue that when number one, number two are close, they tend to have very subtle sentiments between them. They want to compete, they want to do something to contain the other side. I think this situation will probably last for about 2 or 3 decades. China likely will catch up with the US on total size by 2040. And you give China, maybe takes another 15 years for US to become 2/3 of Chinese size. So, that will be like 2055, 56.
Okay.
So which means that the situation will last for 30 years. So we really need some smart person, politician, to figure out how to build up a new governance, system, given that situation.
We're out of time, and I'm looking forward to talking to you at Bloomberg Invest 2055.
Okay, thank you very much. Yeah.
Thank you. Thank you.
Please welcome to the stage Hao Hong, Managing Partner and Chief Investment Officer at Lotus Asset Management, Rebecca Chung Wilkins, Asia Economics and Government Reporter at Bloomberg, and Robin Seeing, Chief China Economist at Morgan Stanley, for a conversation with Bloomberg's Stephanie Flanders.
Well, thank you very much. And I should say that you have the added excitement, despite we're not only going to have a discussion around where we are in US-China trade and much else with these distinguished experts and my colleague Rebecca, but you also get to be part of a podcast episode that will go out shortly later on today of Trumponomics. You can see the logo there. So I also sort of apologize because there's a little bit of clunky stage management that goes with that. I will start doing, I will do an introduction, and you have to all pretend wherever you normally are when you're listening to podcasts that you're, well, maybe not in the shower, but if you're walking the dog or whatever, that's the kind of mode that you should be in. We're sitting around feeling conversational. So I'm Stephanie Flanders, Head of Government and Economics at Bloomberg, and welcome to Trumponomics, the podcast that looks at the economic world of Donald Trump, how he's already shaped the global economy, and what on earth is going to happen next. And this week, we're recording Trumponomics in front of an audience who seem very alive, from Bloomberg Invest Hong Kong. And we're looking at what Trumponomics means for this part of Asia, notably mainland China and Hong Kong. And overnight, we've seen the latest round of trade talks in London between the US and China conclude with what our Bloomberg geoeconomics analyst Michael Deng has called a tactical de-escalation, but not a strategic reset. So we're none the wiser on where tariff rates will end up, or how deep the much discussed decoupling of the world's two largest economies will go. But we have plenty to discuss, and I'm sure plenty of theories on these two sofas here as to what direction we're going about all of that, and maybe also the future of the dollar. I have some great guests to help me talk this through. As I mentioned, my colleague Rebecca Chong-Wilkins, Asia Economics and Government Reporter for us at Bloomberg, Hao Hong, Managing Partner and Chief Investment Officer at Lotus Asset Management, and Robin Ching, from the Chief China Economist at Morgan Stanley. Now, Rebecca, maybe I'll take advantage of you as the reporter in the room. Just take us up to speed on how you're reading that statement we had out of London last night, and I think we're still expecting a statement from the Chinese about those talks as well.
Yes, I mean, not a lot of detail, in fact, from both sides. Largely all of the detail coming from the US side here, but more than 20 hours of negotiations over 2 days, both the sort of heavy hitters from the US and the China side. Essentially, we are back to, I think, that point in the Geneva truce where both sides were sitting down saying, yeah, maybe something can happen, maybe we can do a deal. We're going back to that pause. But it's important to understand why there was that sort of breakdown in the Geneva truce in the first place. And it really fundamentally is over this issue of rare earths. China introduced restrictions on 7 different rare earths. These were global restrictions, essentially requiring licenses from companies all over the world now, not just US. But in addition, there was effectively a shadow ban on US requiring these licenses. Now, as part of the Geneva truce, a really critical part of that truce was this agreement that the Chinese side would effectively lift that shadow ban and allow licenses. Now, the whole disagreement and the reason why we saw this breakdown between the US and the China side is precisely what that meant. What does it actually mean for Beijing to expedite these licenses? How quickly is that going to come through? On the China side, of course, we are talking about an entirely new system of export controls over 7 different substances. It's a global program. It's deeply complex, 45 days of a review process, etc. And it does seem on the US side that there was an expectation that once that Geneva agreement was made, that there would be a much more rapid introduction and implementation. So that's really at the crux, it seems, of where there was this sort of breakdown in relationships between the US and China. So now it seems, I said it very tentatively because we don't have a lot of details, but it seems like there is a quote-unquote framework to allow this expedited process or allow these rare earths to continue being exported into the US. We do not have any details on what that might mean, and both sides still do need to go back to their respective leaders and effectively run this by, their bosses.
But on the other side, there had been some sort of excitement in the last couple of days when the Commerce Secretary, Howard Lutnick, actually mentioned export controls and was also apparently thinking about some of the US export controls on China, which have been a very sore point for the Chinese. Do we have any clarity on which of those controls were discussed? Because some are much more important than others.
Absolutely. So sort of yes and no here. So we think that some of the immediate retaliatory export controls that the US rolled out when they believe that the Chinese side were not living up to their expectations and the agreement on rare earths, will be lifted. So that includes restrictions on things like domestic technology for software technology for developing semiconductors, nuclear materials, chemicals, some jet engine parts. So these are the latest package of retaliatory measures that we've seen coming out of the US since that breakdown in the Geneva Truce. It's unclear if this will involve some of these more fundamental issues over export controls over semiconductors. That, of course, is the big sticking point, these restrictions that were rolled out under Biden and continue to be expanded. So part of the small yard, high fence range of measures.
Okay, well, Robin Singh, you don't have to, of course, Rebecca has to stick to absolutely what she knows, but you get to just speculate wildly on the basis of very serious economic analysis. How are you reading where we've got to? And I guess, what will you be looking for in terms of the sort of economic impact of these ongoing talks on China right today?
Thank you, Stephanie. I like the word you used, speculating, given all this flip-flop about trade talks. So far, the bid-ask gap between US and China is still very wide. If you look at the readouts from the US side, they are later focusing on trade deal, on upcoming logistics for rare earth, as Rebecca, you elaborated. But the Chinese version, Beijing's readout, covered a much bigger picture. They want to reset the grand relationship between US and China, covering tech curbs, student visa, geopolitical issues. So apparently, Beijing wanted a grand bargaining deal. So I think there is a huge gap between the bid-ask, and that means the ongoing talks won't be easy. Maybe they can extend this trade tariff detente, but what Beijing wanted is beyond tariffs. And Rebecca, you mentioned the rare earth. Now China is using it more like a strategic card because of the tech curbs. So what you said is like Beijing thinking, if you cut our chips, I will cut your magnets. And over the last 7 years, since the first trade war in 2018, China has strengthened its dominance in key supply chains like rare earth. Today, they control more than 80% of rare earth refining capacity, more than 90% of the magnet production, which is widely used in next generation of tech and the supply chain, including EV cars, humanoid robotics, even modern defense system. So now China is using that in exchange for potential relaxation of tech curbs. That's also part of Beijing's strategic play, sending a message to US allies, making them think twice about aligning too closely to the tech curbs on China. So I do think all of these showed China wanted a grand bargaining deal covering not just the tariff, but the tech and geopolitical issues. Given that's not going to be easy, you may see continued uncertainty on trade talks. So our base case is by end of this year, the US terminal tariff rate on China will probably stay similar to today's level, 30%, 40%, given all these difficulties and the divergence of Beijing and Washington's readouts. And that's going to cost the foreign firms margins, cost the Chinese exporters jobs. So it's still a downside risk to the economy.
Hao Hong, I guess I'm struck by, it feels like the US side had not fully grasped how reliant key parts of the US supply chain was on these rare earths. And I'm kind of reminded of the depiction someone had of the ongoing debate, which is the US has decided they absolutely want a divorce from China in 10 years' time, but live together in the interim for the entire 10 years. That is the challenge that you see in some of these talks.
Yeah, well, I think it's similar to a couple fighting through a divorce process, right? So the two parties don't see each other in the future, but then at the same time, they still have to live with the consequence and how to divide up the assets. I think, just now, Rebecca and Robin mentioned about the rare earth, and also at the opening, you mentioned about the progress at the London talk isn't as smooth as it should be. It is because, the counteroffer from the US part is probably too low, too sort of not good enough for China. All right, so I think as a result, even though China has agreed to sort of restart the approval process for rare earth exports at the Geneva session, the Chinese can always run a slower than expected process to approve it, right? So normally it takes probably 1 to 2 weeks to approve to get a permit for exports, and now it takes 2 months, right? Then that way, on the surface, on paper, China is not violating the agreement, but then at the same time, you're still not getting your key ingredient for your GPUs. So I think China can do a lot of these things to slow down the process, and also at the same time, people have to recognize the situation that in the U.S., I think the American consumers probably can't live for much longer at the higher prospect of much substantially higher inflation. And then at the same time, because of the process of this trade war and how this trade war started, it actually somehow united the Chinese people together. Right. So if you're in mainland China, you can really feel the atmosphere, rooting for President Xi and also rooting for China in this negotiation process. So I think the Chinese people is very famous for eat bitter, right? So in the Chinese culture, eat bitter means you can endure substantial hardship for a very long time. So as a result, as you can see, this group of people is ready to fight. But then at the same time, the American consumers really want to get cheap goods. So then that way you can see, the China can afford to wait while the Americans probably can't. And so I think it's setting a stage for the negotiation. So I think one shouldn't be too surprised that, as China jack on, then the Americans would have to give more concession during the process. And then towards the end, we probably get a result that is more favorable than expected for the Chinese people.
And just to follow up on that, I mean, if I noticed, the World Bank's obviously brought out some new forecasts this week, and I think it's cut the growth forecast for 70% of the world's economies, almost all of the world's biggest economies. It's halved this year's forecast for the US. The only country that it hasn't cut the forecast for this year and next is China. So I guess, just to come back to you, Hao Hong, is China, at this point, is China winning the trade war? Is China coming out of this certainly much better than the US?
Yeah, well, I think it's much better than the trade war phase 1 in 2018, right? So I think, during the current trade war, China is more prepared than before, and also China is ready to use the asymmetric retaliation towards the U.S. counterpart. So I think as a result, on the surface, the Chinese growth is steady, Chinese exports is steady, and if you look at the Chinese domestic economy, you're seeing, two parts of the economy. One part is export manufacturing driven, that is doing really well. So even though the exports to the U.S. has been down like 1/3, but then to the rest of the world is really booming. And then at the same time, if you want to bearish on the Chinese economy, you can look at the consumer sector, right, which is way below expectation and is still not recovering. And then if you look at the housing sector, the housing bubble bursting process is still dragging on. So depending on which part of the Chinese economy you look at, and then you can draw very different conclusions.
And it is interesting, Rebecca. I mean, we have debates in Bloomberg and with the economists as well, because we'll have analysis of the sort of long-term, obviously, that the growth trajectory being lower for China and what that means in terms of people's expectations after years of double-digit growth. But alongside that sort of pessimism around China, the Chinese economy, we'll also be reading the latest release of the breakthrough with DeepSeek, or the latest incredible charging technology for electric cars, where China seems to be powering ahead much faster than people expected. So, how do you sort of deal with that schizophrenia day to day when people are asking you, how's the China economy?
Well, I think to Hao Hong's point, to a certain extent, it really depends where you look. And clearly there are areas where we've had, most notably high quality manufacturing, where enormous amounts of investment have been pouring in. And you do see the clear emergence of winners among Chinese firms. Think about electric cars, think about DeepSeek, AI. These are investments that have been going in for the last decade or so. We can think about the China 2025 plans, for example. By and large, aside from semiconductors, China has met all of its aspirations in becoming either a global leader or one of a global leader in those key sectors. So in some ways, China is meeting its own tests. But on the other hand, to Hao Hong's point, there is still this quite painful transformation that is being ushered away from a debt-driven, property investment-led society, and that clearly does still provide drags on the economy. I know at Morgan Stanley that you have your own sort of social metric index of content in China, if that's one way to put it. But another way is when you kind of look, for example, at private data sets at protests in China. Now, they're relatively small scale. We're talking about in the hundreds. But by and large, we have seen those continue to climb, particularly over the course of this year. They tend to be very economic focused. These are economic issues. They're rarely political, in fact, actually. They're often around housing issues. They're often around unpaid wages. So to that point of knowing sort of where to look, is you can see these pockets of real tension, particularly at the local government level where finances are really strained. And then overall, when we think about the consumer mood, of course, you know, most consumer indexes will still show that we are pretty far from where we were pre-pandemic as well. So overall, that mood is different. But to Hao Hong's point, I will say there has been a remarkable transformation in how this is all viewed as a result of the trade war. When we think about last year, there were all of these stories about deflation that, you know, Robin wrote extensively about, concerns about the property market, when we're going to see a bottom, and really the cost for ordinary people of President Xi Jinping's push to transform the economy. Was this really going to pay off? The end of the boom years. So with these sort of quite existential questions we are asking, now we are seeing this extraordinary support from many parts of the economy for President Xi, backing China, standing up, and this sort of resurgence of sort of a nationalism and a nationalist feeling and patriotic feeling as well. So, you know, in some ways that's nothing to do with the Chinese economy. We're talking about the sort of enemy that the US has created for itself. That has changed the national mood in China, I think.
Well, Robin, I think we've established that Rebecca is a very careful reader of your work, but I'm interested in how you see that, and I think also, do we see out of this, you know, we see maybe a change in the mood supporting the leadership, but have we also seen a change of direction from the leadership in terms of its commitment to rebalancing the economy, or is that just wishful thinking on the part of the Americans? You know, a commitment from the top to a more consumption-led economy, which is, of course, what economists have been lecturing the Chinese about for many years.
Well, Stephanie, I think, Rebecca, you are spot on about the change of narrative.
Of course, because she's been reading your...
No.
I have been bothering him for many months, it's true.
She noticed the rise and the decline of readership of my deflation reports. Last year, it was all dominated by deflation, housing adjustment, overcapacity. Then suddenly, as Rebecca, you mentioned, there is a changing narrative, and how you also briefly touched it. At least right now, despite China is not in a sustainable recovery path yet, at least there is a bifurcation of the narrative, a tale of two economies. You have a very dynamic tech economy. Every other week, you heard a new technology progress, either AI model or next generation of batteries or self-driving cars, or even recently, China's healthcare, biotech had its own DeepSeek moment, able to make fast follower drugs at competitive quality at a fraction of the US cost. So all of these are showing a very dynamic tech economy that helped Hong Kong. I think your Hong Kong conference today is becoming bigger, partially because Hong Kong is back with the ecosystem, private equity invested in tech, using Hong Kong as exit channel, creating new money. That animal spirit is largely back. But once you take off your augmented reality glass, you look at conventional consumers, as Hao mentioned, or housing, construction, they are pretty much stuck with deflation. And as economists, we have to explain why this bifurcation happened. I think fundamentally, China has not shifted from a supply-centric business model or policy approach towards consumption-centric. They did some baby steps, social welfare or consumer trade-in, but these are too little. Fundamentally, the local government incentives, the GDP KPI, the government revenue largely relying on VAT, which is linked to production. All of these are showing path dependency. They are still pretty much in supply-centric mentality. And I think, Rebecca, your colleague covered the debate about the next 5-year plan in an excellent way. We proposed that they should upgrade their Made in China 2025 to something called an Open China Market 2030, focusing on boosting domestic demand and consumption in a sustainable way, providing deeper social safety net, that social welfare, household-centric reform to unlock China's consumption potential. However, according to Bloomberg, they are probably still debating on doubling down on tech and the supply side in the next 5-year plan. So I do think that's the reason of the bifurcation of the economy, a tale of two economies. Unfortunately, for a bigger part of the macro economy, they are still stuck with deflation. So volume growth is fine. Stephanie, you mentioned many people maintained or upgraded their China forecast to 4.5% or higher for this year. But that's for real GDP, that's for volume. Once you look at the value or nominal side, we think China's nominal GDP growth will stay at a subdued level of 3.5% throughout maybe the end of next year, given the deflation problem. And the recent example of they did some interesting introduction of self-driving cars. But meanwhile, you see all these cutthroat pricing war during EV car, among all these EV car firms. So that's a perfect example of this supply versus demand imbalance is quite persistent in China.
And just to unpack a little bit for those who, for people listening who are not always listening to the sort of economist debates about this, when you talk about the rebalancing and when you talk about still focus on supply and some of the incentives, I mean, it's an economy that is geared around an extraordinarily high level of investment over many, many years and much lower consumption than you see in most economies, certainly developed, advanced economies, but also economies of a similar income. And the local, what you were saying, Robin, is that the local government officials are incentivized still around just pushing out output rather than getting income to households or providing welfare services. How, just for your perspective, I know when we discussed this before the session, you made the point that this was about not just rebalancing the Chinese economy, but also the US economy. I'm not sure that's the way the US sees that, but just explain that briefly to us.
Yeah. Well, I think, to rebalance, both sides has to work together, right? So I think the Chinese consume too little, invest too much, and then the US, is the reverse. So I think, if you want to rebalance this structure, the US has to produce more, consume less, and then vice versa for the Chinese. I think for China, it's a monumental task in the sense that, if you look at the domestic economy, just now we mentioned about the housing bubble bursting process. Now, in this process, the indebted department of the Chinese economy is really the household. Right? The household is borrowed up to their eyeballs. The non-financial debt to GDP ratio is about 300% in China. Right? So when you have this department that is borrowing heavily to buy up properties, and then now we're in a property price deflationary process, it's very difficult for this department to deleverage, because this department cannot print money. But then on the other hand, the U.S. is a different situation where you have the public department that is, borrowing up a lot of debt, and then the U.S. households' debt service ratio is still at all-time low. So in this economy, in this kind of economic structure, then you will see an inflationary process. You see, the U.S. government can't keep its budget deficit down, but then at the same time, you're facing higher and higher inflationary pressure. And then in China, it's the opposite. So I think if you really want to rebalance, it's a global rebalance process. It's not just about China. If you look at China, so the way we manage our economy, right? So we try to rebalance it for like decades. I remember still, since 2007, right? So when the ex-government was still in charge, there was this saying about the managing Chinese economy is about is riding a bicycle, right? So if you too fast or too slow, it would tip over. I think if you look back now, 15, 18 years later, almost 20 years later, we look at the Chinese economy, it's actually more investment driven than before. and, and less consumption. Right? So that is telling you that whatever happened in the past 2 decades hasn't been successful. So we have to change the way of thinking. For China just rebalancing on its own, it hasn't been successful. I think it's a global rebalancing process.
And we're going to run out of time, but given that this is the Hong Kong Invest Conference, I want to just say something a bit about not just the rebalancing of the individual US and China economies, but I would say globally there's a sort of rebalancing in markets that's happening. We're seeing the dollar fall relative to every currency, but certainly many around here. And we are seeing a reallocation of investment. People are still heavily invested in the US, it's hard to avoid, but certainly at the margin we're seeing money flow, particularly perhaps into this region. So, I mean, Rebecca, does that, just tell us a little bit about how you see the impact for Hong Kong as a financial system, for the relative role of the dollar here and investment sentiment?
I think there is this, in this part of the world, not just in Hong Kong, but in Asia, this broader question of the role of the US dollar going forward. And I think, there will be people in this room who, over the last year, whether it was trading the Taiwan currency, whether it was trading the Japanese carry trade, who have been on the forefront of feeling this sort of this shift in the tectonic plates. Essentially, there was a big debate over whether or not actually we were seeing some kind of reversal of the Asian financial crisis, essentially declining confidence in the dollar, strengthening local currencies, and whether or not that would essentially mean a massive return of capital back home. Now, that sort of phenomena hasn't really started already yet in massive numbers, but certainly we are already starting to see that playing out. And I think for many Asian countries, broadly speaking economically, there's this question of how that impacts their export-driven economies that have, of course, so relied on that currency disparity. But also from a sort of financial markets point of view, there will be this question of how deep and liquid home markets are and their capacity to absorb back that home currency. And whether if they are sort of, I suppose, mature enough to start adapting that back. But by and large, there is this potential good news story that we will see this sort of reinvestment back into home currencies. I took a trip to the US not so long ago, and I spoke to a lot of US fund managers, particularly outside of New York and places in New England and so on. And what struck me that was sort of really remarkable is anecdotally, although a lot of them are persisting with their various macro and global trades, they're bullish on the US, they still believe in the US exceptionalism story. By and large, almost every single one of them told me that when it comes to their personal investments, they were all worried about overexposure to the dollar. They were all worried about thinking about where else I diversify, what other currencies, do we go to gold, even though it's too late, etc. I just had this conversation come up again and again and again. It's so interesting taking that into the Asian context and how that resonates with traders and investors here as well.
Robin, I mean, briefly, you mentioned the role of Hong Kong, but do you also see, just a long-term shift, this reversal of the Asia financial crisis, if you like, for this region?
Hong Kong benefited from 3 waves of inflows. You mentioned about the capital flows. First wave since September last year. Policymakers in Beijing believe stock market is a very important confidence vote, confidence proxy. So in terms of national team or reserve management or China's sovereign wealth allocation, now they value Hong Kong more than ever before. That was stage 1, more driven by government. Then after this, earlier this year, DeepSeek movement, people realized, okay, China still has these innovation capabilities. And due to legacy issues, a lot of big tech names are listed in Hong Kong, not in onshore China. So Hong Kong benefited from that narrative change. Okay, China innovation and animal spirit in tech is back. Recently, the April 2nd Liberation Day, and as you, Stephanie, and Rebecca mentioned, people are debating on is there any falling of US exceptionalism, weakening US dollar, and the third wave of inflows is not from global money yet, it's from Chinese offshore money. high net worth individuals or exporters who parked too much of their money in US assets in the last 5 years. They were too exposed to US dollar assets. Now they are participating in things like Hong Kong assets or Hong Kong IPO, so-called high quality renminbi assets listed in Hong Kong. So Hong Kong benefited from that. But the final wave, the most important one, has not come yet. Global money allocating to China and Hong Kong. Well, China is participating in this debate on weak dollar. Maybe China can benefit from that. But I don't think they are fully ready to seize this moment. They need to improve policy transparency. They need to reflate and rebalance, try to get rid of deflation problem. If Beijing can deliver this, I think they will benefit much more and fully seizing this opportunity of so-called diversification away from US dollar. But so far, Hong Kong money is mostly Chinese money, either from Beijing or from offshore Chinese. That's the way they benefited so far.
Hao Hong, we'll have the last word to you, but do you agree with Robin that we're just at the first stage of a process? There's quite a few steps to go if we're going to have this shift in the center of financial gravity in this direction?
Yeah, well, I think more likely than not, the US dollar will continue its depreciation process over the next couple of years. I think a very strong US dollar has been a symptom of the global imbalance, and also the Chinese currency is way too weak. And I think one of the reasons why the Chinese currency was so weak was because, firstly, we have to maintain the edge in our export sector. And then at the same time, I think the Chinese currency rate is more driven by capital flow rather than trade flows. So I think as a result, in the past couple of years, you're seeing capital keep flowing out of China and going into the U.S. capital market, and also for the U.S. dollars that the Chinese exporter have been receiving, they have been keeping it overseas to be reinvested in the U.S. market. So I think as a result, you can see in the past couple of years, the Chinese currency has been weak. It's because of the direction of the capital flow has not been favorable to the Chinese currency, but now the table has turned. I think the narrative of the Trump administration is making itself hostile not only to the Chinese economy but also to the global economy, actually hitting hard on the allies as well. All right, so I think in this process, and also after the Russian and the Ukraine war, I think people start to realize that the U.S. dollar holding may not be as safe as they once were, and now they have to think for themselves. So I think as a result, we're seeing money being reallocating out of the U.S. market. Otherwise, how could you explain, right? So after a very significant risk-off event on the Liberation Day, the U.S. dollar continued to depreciate, and I think the process could accelerate from here.
Well, this is making me feel a bit old talking about the full circle from the Asia financial crisis, because my first ever trip to Hong Kong was in the autumn of 1997 with the US Treasury. I just joined the US Treasury. It was the World Bank meetings, and we were just getting to grips with, at that point, the crisis in Thailand, but of course it became the financial crisis. I'm not sure we're full circle since then, but we've certainly come a very long way, and in this region probably most of all. So thank you very much for listening to Trumponomics from Bloomberg. It was hosted by me, Stephanie Flanders. I was joined by Bloomberg's Rebecca Chong-Wilkins, Morgan Stanley's Robin Singh, and Lotus's Hao Hong, with special thanks to the team at Bloomberg Hong Kong Invest. Thanks very much.
Thank you.
Please welcome to the stage Steve Bryce, Global Chief Investment Officer, Standard Chartered, and Jean Chia, Global Chief Investment Officer, Bank of Singapore, for a conversation with Bloomberg's Eric Schatzker.
Please. Good morning, everybody. We are indeed fortunate to have with us not one, but two Global Chief Investment Officers, both of whom have traveled to be here with us today. Thank you very much.
It's lovely to be here.
Thank you.
So, one of the questions that I like to ask CEOs, in part because it promotes accountability but also because it's fun. Maybe more fun for me and more fun for the audience than it is for you, Steve, or you, Jean, is to ask CIOs what you got right and what you got wrong.
We're very good at the first one. Okay.
So it goes without saying that this is a year that has already, right, been full of surprises, and we're not even halfway through yet. So being in the prediction business is never easy, perhaps harder still in 2025. I admire your bravery. Jean, let's begin with you. When you look in the mirror and you say to yourself, gosh, you're a clever girl, Jean, or you say to yourself, oh, Jean, you need to do better, what are you talking to yourself about?
Well, the great thing is I hedge myself most of the time. Being an economist by training, it's on the one hand, on the other hand. So what I got right, or what we got wrong. Let's go with the wrong, because I think a lot of us will blush at the same time, is US exceptionalism. So I kid you not, Outlook 2025, high hopes that US exceptionalism will prevail. And Trump has made a lot of election promises that we believed would come through. Lo and behold, reality check, that was a rude shock come Inauguration Day, Liberation Day. And we all know that story. What we got right, however, is that we always believed in diversification. So we've actually upgraded Asia ex-Japan as early as Q3 of last year with a preference for Hong Kong, China. Probably in the short run, we would have been wrong, and there was a lot of skepticism. But that's the beauty of asset allocation, that's the beauty of diversification, is that if you have patience, you are ultimately proven right. And this year it's been a great trade on two fronts, which I shall discuss, which is really the benefits of diversification, but also the fact that the currencies have worked in our favor. So that certainly is, I say, the one hand and the other.
Steve, what about you?
So I think in terms of what we got right, I think we'll find out whether we got one part right, which was our view was that equities would go up point to point through this year, and obviously so far that's true, but obviously we're a long way from the end of the year. And we said, but it wouldn't be a smooth ride, so we were talking about a 15 to 20% drawdown at some point in global equity markets. And obviously, at least as far as US equity markets, that's exactly what we saw. And then we'd say,
in April, yes.
Yeah, we'd get the Trump put coming in. Now, we were right for the wrong reasons, because I think it was probably the Treasury sell-off that actually prompted the recalibration of trade policies, to put it politely. But we did see that pull back, and then obviously we've gone to the races again. Actually, I think that's the key. I think and a similar point actually to Jean's in terms of what we got wrong. I don't think we didn't see the dollar weakening to the extent that we've seen it now. In the big picture, we are back to about the middle of the 5-year range. So that's not, I think there's a lot of over-dramatization about the dollar weakness, and I'm sure we'll talk a bit about the outlook here. So yes, we've seen a 10% drawdown in the dollar on a broad-based basis, but really we're just at the bottom of the range. So we haven't really broken out yet. But that clearly we weren't looking for a 10% down move in the dollar this year. So it's interesting where we go from here.
Each of you has to process in the, as you figure out effectively what positions and allocation to recommend, an enormous number of variables. Of all those variables, right, that are going to have an impact on the outlook for global assets, which ones stand out to you right now as the most important, Steve?
I think it's not really a variable. Maybe we can look at it in one way where it is, but it's really to the extent that what's happened this year is a permanent shift higher in uncertainty and leads to a permanent recalibration or a semi-permanent recalibration of business intentions. So we've talked to obviously a lot of entrepreneurs, small business owners, and the key thing immediately after the Liberation Day was, what should I do? And the reality is you should probably sit on your hands and see how this is going to play out. And just everybody doing that around the world leads to economic impact.
Sure.
So the question is, to what extent does that lead to the genie being out of the bottle, and therefore, regardless of trade deals being done, etc., we could still go into recession. And the other way to look at this is the soft data, hard data gap has obviously been widening. If you look at economic expectations, the economic surprises index, the soft data is underperforming massively and the hard data is outperforming massively. That's going to narrow. Which way is it going to narrow? And I think that's the biggest question that we've got to try and figure out as, obviously, if you're an economist, but also obviously as investors as well.
I think that's a very interesting concept, sort of structural uncertainty in a way. What about you, Jean?
So that's where we agree on structural uncertainty. The cause of it, however, I believe that we're actually in the midst of a very seismic shift in terms of the correlations as well as the decorrelations of the variables that we're used to is breaking down. For example, yields and the dollar, right? That used to be a correlation, but that's broken down because there's something underlying that's shifting in terms of calibration of risk. So I think that whole notion of DM versus EM and how we have invested in the past and our attitude towards fixed income portfolios, for instance. So that whole uncertainty means that we have to actually change the way we act. So quite the reverse from being shell-shocked. Our mammalian, as mammals, our response to an attack typically is you either freeze, fight, or you fly, right? I think as human beings and very sentient ones in the room, we actually have to strategize. And so as a bank and as an investment team, what we've done is say that what is the strategic shift we need to do as investors? And so we looked at our strategic asset allocation framework and say to ourselves that if all these variables are breaking down, that forecasting ability goes down. Are we going to change the way we allocate assets? So we've gone through a whole robust optimization model, quite a lot of data involved, historical and also forward-looking, to recalibrate how investors should think about their portfolios. And I think the deep work we should be doing as individuals as well as investors is to say to ourselves, with all of that changing, the blocks breaking down, countries having different relationships from each other than we were used to post-Cold War, what does that do for our investment forecasts?
I want to pick up on something that Jean said, actually, in terms of the correlation. You talked about dollar and yields, but actually, if you look at it in the recent past, the dollars actually look like a risk-on vehicle, right? So if risk is doing well, the dollar's stabilizing if risk is off, which I think is probably the opposite of what people thought. Again, coming back to what we got wrong, you go, okay, risk off, dollar does well, right? The dollar smile, the infamous dollar smile, right? So I think that's the challenge. So, obviously a lot of people worried about how far the dollar could go. Actually, our view is that the market is massively underweight the dollar and US assets. So we could still see in the short term a melt up or climbing the wall of worry for US assets until that positioning corrects itself. But then longer term, you say, okay, is the dollar going to crack? Certainly Trump wants it to crack, right? That's one of his policy objectives. He doesn't want the treasury market to crack. So there's a bit of a trade-off there for what they're trying to achieve. But if you're saying, okay, if I need to hedge against long-term dollar weakness, let's say I take a view that the dollar's going to weaken another 10% over the next 12 months, then what do you do? And actually, you invest. Now, most people, their reaction has been, oh, short duration, hunker down, this freeze or aspect. And actually, if you're worried about dollar weakness, you should be invested because dollar weakness is very good for assets generally, both equities and bonds historically, assuming this short-term positive correlation with risk doesn't continue. And so that is usually a great way to hedge against dollar weakness. And that includes US assets, not just EM, although obviously in that environment, historically, non-US generally outperforms the US assets over the longer term.
Perhaps I'll share a little bit of what that conversation is with wealth clients. And that's actually resonated with a lot of clients. Previously, we were preaching the message of diversification, and it was always, but my dollar assets are doing so well. The US market has returned exceptionally for the past few years. Why should I change? Increasingly, this now lands better for wealth clients. And here in the region, I mean, typically, the typical wealth management client in Asia has a home currency. It's a Thai baht, IDR, Chinese yuan. Then all their global investments, call it the US bucket, is in US dollar denomination. So we're now postulating to clients, it is not a binary decision, dollar weakness versus my home currency strength, but what is that third currency? If that third currency is the euro, is it the yen? Is it the Sing dollar, for which we think that there's great stability in the Sing dollar because it's structurally managed against a band of currencies in this region. So it offers that balancing act between the dollar linked currencies as well as your home currency and that third currency. I think that has actually helped us to frame the discussion into a more diversified one, rather than a binary decision, is it going to be structural dollar weakness, etc. Yes, but it may not pan out in the short term, but certainly in the long run, a more diversified basket of currencies, because economies are evolving that way, could be a profitable one for the longer run.
Sorry, Eric, I don't want to make you surplus to requirements, but I just want to respond quickly. So I think, look, we get that the dollar is being undermined by policy uncertainty, right? So I think we all understand that. The question is, okay, so, and that's leading to marginal changes. So that, just to be clear, the European versus US trade, okay, Europe has outperformed significantly this year, but it's still in a long-term downtrend, right, over the course of the past decade. But I think what is, everybody is sort of saying is, okay, I understand that the US is weaker in some sense in terms of policy certainty, but to what extent are other people picking up the baton from the US? And I think that's where people are struggling and saying, yes, okay, you've got German fiscal stimulus,
it's early days,
etc. You've got what China's been doing to sort of try and support the economy, etc. But it's just, it doesn't feel like there's an obvious person to take over.
One of the things, and you've both touched on this, but I'd like to go a little further. One of the things I'm particularly interested in understanding is how your clients are processing, if you will, what the Trump administration has been doing for the past 5 months. And there's a lot going on, right? You have, obviously, tariffs and Liberation Day and the threat of inflation, but also the threat of stagnation. You've got encroachment on monetary policy from the Oval Office, you have the big, beautiful bill and maybe an additional $2.4 trillion of deficits. You have the weaponization of the Justice Department, right? The potential withdrawal of the US from global security alliances. I could go on. How are people thinking about this? Do they see this as being a structural change in US policy? In other words, henceforth, the United States is a different place, and we need to think about it differently as investors.
So I think the starting point for me is, look, everybody realizes that the US is still very important from an investment perspective, right? So, but I think what we're seeing more and more now is that clients, yes, they did a knee-jerk going short duration, etc. But I think the people that take the portfolio approach that Jean was talking about at the start, they're seeing the benefits of that coming through. So if you look at, our balance strategy is up 5 to 6% this year. And if you told me at the beginning of the year what was going to happen on the fundamental side, and then said, what will your balanced portfolio do? You probably wouldn't think it's going to be up. You probably think it's going to be down. So I think that's where people are sort of saying, actually now they see the benefits of that sort of diversified approach, and that is becoming a much more core part of their portfolios.
I think for us, let's talk about the positives first. If you look at the Trump administration and the tariffs, right? Tariffs are as old as the hills, as early as 1776. Adam Smith didn't write Wealth of Nations for nothing. It was really about trade, and there was protectionism at that time of wool mills in the UK, or coal mines, etc. So that whole narrative about trade, it is not zero-sum. At the end of the day, we all know that by trade, we actually create a bigger pie as a globe, and there are coincident and intended and unintended benefits as well as downside of global trade. So that's that moment of reckoning, and I think, that whole adage of, Trump always chickens out. which was coined by the FT. It's a neat meme, but what it really brings us back to is pragmatism. We have faith that governments, companies, countries are pragmatic at the end of the day. So case in point is, of course, the conversation or the negotiations overnight in London between the two, between US and China. And that's just a recognition that let's get real, guys, right? Let's be pragmatic about the whole thing and see where those trade-offs to. So I think that tariff tussle, if you like, is more a means to an end rather as an end to itself. So that gives us some hope and optimism that ultimately that prevails. What, however, has changed is the erratic nature of policy shifts and that erosion of faith in the US sort of policy-making apparatus, let's call it. Because I think traditionally we have expected things not to happen overnight. For instance, we had time. We know when the FOMC meets. We know when the next Senate hearing will be, etc. So that level of predictability now makes it calls to question whether, as a developed market versus an emerging market, should we look at them on level playing field? So Asia, for instance, emerging Asia, are they actually on level playing field where we need to calibrate the risk reward and factor in the uncertainty just as much as any other market? And the US, just because it's the largest and the DM, doesn't give it a free pass in terms of our reckoning of the risk reward.
I want to hear from you in a moment, Steve, but since Jean brought it up, and it is so topical, are you both believers in the taco trade? Does Trump always chicken out?
I think he is a pragmatic person, and you can see that on various fronts.
Very well put.
Pragmatic. What do you think?
I think...
So yes?
If it's in the US favor, yes.
I think the key is pressure has to be brought to bear, and I think China played the card of the rare earths very well, right? I think Europe, I'm sure that Trump hates the taco label, so he will look for opportunities to prove that it's not there, and I hope Europe finds its rare earths, because otherwise things could get messy again for a while. That's probably where I'm a little bit concerned.
We've heard a lot already today about U.S. exceptionalism, and this notion of U.S. exceptionalism, or the argument in favor of U.S. exceptionalism, is based on the belief, right, that America's historic commitment to democracy and to liberty and to free markets sets it apart from all the other economies out there. And in finance, and Steve, you've actually put this in some of your writing, it's translated into consistent outperformance for more than 30 years by U.S. equities and, of course, the U.S. dollar as well. It feels, and you've both touched on this, that we're in a different place right now. Do international investors, the ones you were talking about, Jean, the ones who are naturally long, whatever, Thai baht, ringgit, whatever the case may be, do they need to recalibrate the risk premium that they attach to U.S. assets?
I believe so. So I think that is exactly what's happening at this point, where we're seeing perhaps at the margin, and this is happening in investment committees as much as in individual investors' conversations with us, is the need to prepare for a period of uncertainty. How do you hedge yourselves? So gold was mentioned as well. That's one of the asset classes that we favor, as well as uncorrelated markets like private markets to some extent. But each segment or sub-asset class needs to be calibrated according to the new regime of uncertainty. I think that's very core to our belief in terms of what has changed from last to this year and henceforth. So I think that's really important for any investor right now to just be cognizant of that. Yeah.
I think that there's two things that I would sort of put out there as questions rather than giving answers, right? So I think the first thing is, in the US, does Trump get constrained at some point, either by his own party by the Democrats or by the midterms or the courts even, right? And we've had that thrown out there. So, and to what extent would that then reduce the risk premium in terms of policy uncertainty? I think that's one question that we still, it's very easy to focus in the here and now and on the Truth Social, are they tweets? I don't know what they're called, but on those, that policy-making vehicle that we have, there is Truth Social. The second thing is, everybody's very focused on AI and tech and communication services as being a key driver. And the US clearly has a lead in that space. So from that perspective, you're like saying, okay, how are other countries going to sort of fill that void? And obviously the DeepSeek moment in China was a very significant event. You almost need to see something in Europe as well. And those are the two questions I sort of say, okay, I think I share the sort of sentiment saying, yeah, it makes sense for this long-term US outperformance to come to an end. But then you look at those two factors and you might go, it's probably just too early to call it today.
I think I'd like to maybe differ from Steve on that point. I think, again, history is no guide of the future in innovation as well. And what's a little bit troubling, of course, is the attitude towards skilled immigration and skilled immigrants in the US, case in point, the Ivy League colleges, et cetera. And does that mean that if all else equal, a brainy person anywhere in the world no longer thinks that there's only one magnet where they can operate at their most optimized level? And actually, there are many countries in the middle, whether it's Europe, Middle East, Canada, or Asia, right? Hong Kong, China, Singapore, and even the ASEAN countries. Is it now a world where actually there is equal opportunity or maybe a much more balanced opportunity that innovation could come from somewhere else? And there could be different languages and different types of data analytics from the AI sort of technology development that becomes efficacious for everyone as well. So to that extent, I think we cannot assume that innovation will only come from the US going forward. It's a healthy thing for the world. So we tend to think of things in longer term horizons, 5 to 10 years, as what we call super trends, which are structural. It involves demographics as well as economic growth and also the I like to call geopolitics / geoeconomics, because I think geopolitics is no longer just a political discussion. It's begun to weave into our economic forecast as well. So I think those structural trends are going to guide investors in terms of a slightly longer term horizon.
I want to finish by asking you both a yes/no question. You're going to hate me for it because it's not an easy one to answer yes/no. Yes or no, should investors still think of US Treasuries as risk-free assets?
No.
No.
There you have it, ladies and gentlemen. Steve Bryce, Jean Chia.
Please welcome back to the stage Bloomberg's Shonali Bassick and David Ingles.
David.
Hey, what's up?
That was the perfect place, really, to end the first part of the morning session because it is somewhere we're going to go later this afternoon with more of our guests. I know I'm going to be speaking with Allianz Global CIO, a European investor who's focusing more on Asia, who's also looking at the risks to the United States. And what we were looking at in the break was the market.
Yeah.
You saw the divergence.
The markets in the Asia Pacific are doing quite well. In fact, I think we're now at about 3.5-year highs. The divergence, to your point, right? US futures are now falling, and it really sets up that perfectly from Eric there, this potential pivot point with the 30-year auction, of course, that we're looking ahead to. I think it's Thursday, isn't it?
It is Thursday, and I have my eyes very closely on that because, of course, a lot of the biggest buyers of U.S. Treasuries have indeed been in Asia.
Yeah.
The other thing that really struck me from this morning was that conversation during Trumponomics, during the podcast from Morgan Stanley's economist in China, this idea that even though we've de-escalated some of the tensions between U.S. and China over the course of the last couple of days with the talks in London from the Trump administration, there's still a wide bid-ask spread.
Which, I guess to your point, the question, in fact, the question right after I came off stage, I went to the show, and we were doing a live with Stephen Engo, a chief North Asia correspondent. The question I actually asked him was, are we actually now any closer or any further along compared to the day after Geneva? Because, you know, for the longest time, China was asking for two things, trust and respect. And to some extent, that was a reset to that point, but are we any closer to the core issues?
The clock is ticking.
It is ticking. It's, I think, it's July 9th and August 12th. And don't ask me how I know that top of my head.
2/3 of the way into that 90-day pause, but who's counting?
Yeah.
I think another interesting thing about that is if you look at the front page of the Bloomberg terminal right now, it's full of stories where you see investors who have been overweight U.S. assets and stuck with that reality today. And in the meantime, you've seen U.S. investors that are pouring billions of dollars and raising billions of dollars worth of funds to deploy here. I think that will be a lot of my focus when we come back from the break.
Absolutely. The analogy, I'm just going to think of an analogy there in terms of this, the overweight to U.S. I mean, it's a conversation that keeps happening. It's consistent here in our programming here. You know, to what extent do you lean further away from U.S.? I mean, we all know about home bias, and it's almost like a turtleneck in most people. Like, it's not going to work, but there are people who will continue to try it, and it will work for some people, right? So
I'm glad I'm a turtleneck person.
no, neither am I. But yes, it's does the U.S. equity market merit a 70% overweight given its share of GDP? But that's a whole other can of worms that I guess you'll get into later.
Well, the question is, are dollars moving or is it marginal dollars being spent elsewhere?
That's right.
We're going to let you guys have a networking break. When we come back, we're going to talk to Matthew Michelini of Apollo Global Management, who in recent years moved out here from New York to build the Asia Pacific practice for Apollo. So a very perfect person to talk to about some of those trends. We'll see you after the break.
The program will begin in 10 minutes. The program will begin in 10 minutes. Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
Please welcome to the stage Bloomberg's Sonali Basak.
Welcome back, everyone, from the morning session, the part 2 of our morning. I hope you got to try the coffee cart. The coffee is excellent. Thank you to the hundreds of people who are here with us in Hong Kong, but also to the many more people who are joining us virtually as well. We love how engaged you've been throughout the course of the morning. Let's keep it going. And if you take out your phones, we're going to bring up a QR code here to share with you. These codes are also on the back of your badges to answer a poll. The poll for the next session, and something that will guide the course of a few other conversations we have, of course, too, is which factor will be the biggest driver of growth in Asia's private credit market over the next 3 years. Some of the options here: banking regulations, the constraints that they've had on the banking sector and the money that it will then flow to the private markets. Differentiated returns, will that be the biggest reason? Or will it be the fact that there is a rising demand here, just cross-border, and across borrowers as well, importantly? We'll wait to hear from you. Please do vote. We're going to reveal the results in just a moment here. And a quick reminder, please do engage with us on social media as well, on #BloombergInvest, wherever you are on social media. And while we wait for those responses, I would like to welcome somebody who is very, very deeply steeped in this market, and that is Matthew Michelini. He is the partner and head of Asia Pacific at Apollo Global Management.
Look, I think that the increase in inflation, the increase in rates has been a major boom for our business in Japan. On the investing side, when you think about it, money's been free for essentially 30 years.
We're big fans right now of Japan. Japan is the largest destination of our capital.
Thank you for joining us here. We set the stage a little bit for you here on why this region has been so exciting. But, you know, it's interesting. I will start with you with Japan, of course, but we will talk a little bit more about the region. Between the structural changes in the macro environment, let's dive into what's creating the opportunity here, starting with the macro. People say that the changes in the interest rate regime might be one big reason we're seeing a potential sea change. How much will it matter?
In Japan, it's going to matter a lot, and thank you for having me here. In Japan, it's going to matter quite a bit. I mean, the macro factors that Japanese companies are faced with right now: rising inflation, rising rates, less labor, and therefore wages are going up. They haven't seen a change in cost structure in 3 decades. So, you know, the Japanese government was actually quite thoughtful in saying, how do we arm an economy that's been financed with 0 rates, which has financed stagnation for the last 30 years. It's financed losses, it's financed excess labor, it's financed excess assets. How do we give the tools to these Japanese companies to respond to these macro challenges? And there's been a number of changes. METI has come out with a number of changes. The Tokyo Stock Exchange has come out with a number of changes. And so you're seeing this wave of this big catalyst that is creating a wave of transaction activity, both for activists, for spin-offs, for buyout shops, for private capital providers. And so that's why there's a lot of excitement with Japan right now and how they're going to face these macro headwinds.
Let's talk more about the structural changes in a moment here, those shareholder-friendly rules, but more on the macro for a moment, because the higher interest rate regime, there's a question of what it's meant. For the Japanese funding currency to have fueled so much investment across the world, particularly in the United States, with Japanese institutions being such large buyers of US assets, US treasuries in particular. A large global investor recently told me that there could be a sucking sound that's underneath the market out of US assets. Do you believe that?
It's hard to have a really solid view. I mean, there's a couple different dimensions on how to answer this. If you look at just pure carry trade, nobody knows how much of the carry trade is unwound, but if you just look at the carry that you're getting versus the volatility, it actually doesn't make sense to put on a carry trade for at least US assets. Then if you look at Japanese companies actually investing in hard assets versus Japan, the Bank of Japan a couple years ago indicated to insurance companies, to banks, to companies, don't use cheap yen to go finance your assets in the US. We need it to be currency matched. Because if you sell the yen to go invest in the US, we, the BOJ, we're just buying it back in the market. So go raise local currency to fund the local assets. And the final thing is, where would you see that sucking sound come from? It's not coming from the life insurance companies. The life insurance companies, as rates started going up a couple years ago, they were short duration on the assets. They rotated to match their duration. This is at a good time because the new solvency standards have just come into place. So I don't think you'll see it from the insurance companies. So there's this weird dynamic between retail, who right now is investing through these NISA accounts, selling the yen, buying US dollar assets still, but pension plans effectively rotating out of fixed income and coming back, global fixed income and coming back to Japan.
It's interesting. I was going to ask you about institutional investors and what it means, but maybe I should ask just as much about retail.
In terms of the difference between the yen and the dollar and what the...
What changes in terms of the way a Japanese investor wants to invest? You are presumably in talks with many types of them on a regular basis, let alone investors across Asia. The advantage you have here is that you could put them in assets in the US, you could put them in assets in Europe. So what exactly is it that investors want to change about their attitude in where they invest?
Yeah, so this is a bit of a unique perspective that you get being in this region versus maybe sitting in the US is, if you walked around the region in December, right after you knew the election, but you didn't really know what policy was going to be, everybody would have told you that they were over-indexed to US assets. I mean, that was before they knew anything about tariffs, before they knew anything about what spending plans would be. I don't think many investors expected a push factor out of US assets. They expected a pull factor. The only pull factors that are large enough would be Europe, China, or commodities. And so I think that what the tariffs have done is they've pushed investors to consider that more and faster and look at different ways to put money into those big geographies. So that's from an investor perspective, they're thinking about, how do I get diversification? Because I'm over-indexed to the US. How do I get diversification? We've been talking a lot about with you. One source of diversification is public-private. The big one out here is also currency now. And so a lot of investors are thinking about, where do I put my next dollar from a currency perspective?
And what's the answer?
There's a lot of different perspectives. I think that there's a difference in portfolio construction and hard asset construction. Hard asset construction, you see a lot of the Japanese looking at places where there's growth and where there's labor, because those are the two things they don't have. And so Southeast Asia is a big one, India is a big one. From a portfolio construction perspective, all of the second-tier markets from a size perspective, Japan, Australia, India, have absorbed almost all the capital that they possibly can. So there's been a lot of interest in Europe. We've made a big push in Europe for private credit. And at some point, I'm sure that these investors who have been in and out of China will turn their sights back on China.
What is it about the structural changes? We kind of alluded to them earlier, the shareholder-friendly reforms that are happening in Japan. On the face of it, you can look at a US hedge fund and you can see why they might want to capture that. From a private markets perspective, why does it matter to you?
Well, it's interesting. Before I came out to Asia 3.5 years ago, there was this accepted wisdom at the time that things in the capital markets will be created in the US and then Asia will adopt them a couple years later. And you're seeing that in private capital. I mean, you looked at the big SoftBank loan that we did. You looked at how we helped Sony finance an asset in the US. There's lots of headlines about how we are helping others finance assets in the US, Japanese companies in the US. Japanese companies are starting to really understand the utility of private capital. For 30 years, again, they just went to their banks. It was cheap. If money is free, you don't really ask what they're giving you. You just take the money. Now that money is not free, and the cost of capital is going up and your cost structure is going up, and investors are asking you to think about how do you optimize your capital structure. Now all of a sudden, okay, you go to your bank for stuff that's really cheap, you go to the bond markets if you need the bond markets, but for anything that you need customized or tailored or longer duration, you look at private capital.
It's interesting. I want to point out the poll results too, because very fascinating. It's not necessarily rising borrower demand. About a fourth of the audience said that that was the reason that private capital was seeing a lot of interest. By the way, in the US, I would bet that that was a higher number in the United States. Differentiated returns, that's the clear leader here. What do you make of that?
Well, I come from a contrarian firm, so I'm going to actually have to disagree. Look, I think that the biggest positive of what's going on from a trend perspective, and this has actually nothing to do with Trump, this is what was going to happen. You've seen increased regionalization. And with increased regionalization, you're going to get business models that don't rely on the volatility that can get created by changes in trade policies. That makes Asia more investable. It means that geographic diversification will actually play out for the first time in many, many years in a portfolio. But I think that the way that the fund structures are set up today and the strategies are set up today, it's really hard to get credit, excess return per unit of risk and credit and scale across Asia, because everything is niche, or everything is just targeted to one strategy, and deployment happens in that strategy irrespective of global pricing trends. So I actually find it mostly on the borrower demand. At least that's what we see in our business. You have, I was mentioning on TV earlier that both in Japan and in Australia, the government and companies are asking, how do we fund a 10-year project? How do we fund a 15-year project? How do we fund a 30-year project? And you compare that to like the Japanese bank balance sheets. Japanese bank balance sheets, on average, their loans are 3-year duration. And on average, they're lending at 175 basis points over. So short duration, high quality. And so how do you get something that's longer duration, or how do you fund a story that needs some diligence? It's going to be private capital. So I think that what you're going to see is you're going to see growth in demand for capital from borrowers, and banks aren't going to necessarily be able to step up with their balance sheet, but they're still going to intermediate most of it out here.
You know, it's really interesting because for those who don't know, you were a very big part of Apollo's story in the push into insurance. Japanese insurance companies, the move that you've been making there in insurance and reinsurance. Explain what's happened so far and explain where Apollo's going with this, to the point you were making that people are looking for different structures for investment right now.
Yeah, so the insurance industry is really interesting in Japan right now. One is, we know Japan is a savings market, but it's a savings market in large part because there's been deflation. And so the rational thing to do is to put your money in deposits or put your money into a guaranteed yield that gets you something better than zero. So annuities worked really well, and protection, life protection worked really well. And we showed through our reinsurance business that we were able to help offer policyholders better yield by taking yen liabilities, investing them in US assets, and then translating it back to US dollars. And we built a very nice, and we have a very nice business in Japan on the reinsurance side. But what you're going to see is, you're going to see with the new capital standards, you're going to see much more of a blend of savings product and investment wrapped product, which actually comes at a very good time, because if you look at the $7 trillion of consumer deposits in the banks, a big chunk of that is with people who are in the final chapters of their life. And when they die, that money goes to their heirs. Their heirs are going to want to invest in investment product. And so, you know, Japan's going to be an interesting market, both from the lens of savings, as well as what you get, for instance, in Hong Kong, with is like a participating product, which is much more of an investment-linked product. So we have, one, the ability to guarantee the yield through our retirement services business, if it's a savings product. And if it's an investment product, we have a whole suite of what we call stay-rich products, not get-rich products, to help savers invest better.
So what does this mean in terms of future product launches? I have very much watched Apollo be at the forefront of the retailization of private funds. I have I guess a joke with one of your colleagues that one day you could see Apollo on your iPhone, right? So what does that mean in terms of the types of products you can offer to Japanese investors, given it seems like there's a fairly competitive thing going on? It almost seems easier to launch a retail product in Japan than in the United States.
So there's going to be a suite of products, just like you have, I'm sure you've talked to my colleague in the US. You have products for high net worth and ultra high net worth, which are really risk-taking products. Private equity, a private equity fund, which is drawdown, locked up money, and you're looking for 20% plus returns. But those individuals have diversified portfolios, and they're well advised, and they're financially sophisticated. You go to all the way to the other end for the average investor. The average investor is going to want something that's more liquid or something that's safer or guaranteed. And so we basically can offer anything in between, so long as it adheres to our 3 principles of excess return per unit of risk, we're focused on downside protection, and that we ourselves, importantly, we ourselves want to buy it alongside those consumers.
It's interesting because liquidity has been a huge topic in private markets. Sometimes it works, sometimes it looks a little risky. How far can you go?
Well, you saw liquidity not work in the public markets a couple times now as well. In the US, you've certainly talked about this with some of my colleagues. There is a convergence in liquidity, at least in the investment grade part of the spectrum, because it's going to be a massive market, $30, $40 trillion, and it's mostly ratings driven. And it sits in the parts of investors' portfolios that need turned over for all sorts of reasons. It could be liquidity, duration management, matching adjustment management, sector and risk management. So you will see increased liquidity there. It's harder to see Asia assets, private assets, achieving the same liquidity anytime soon.
Really? It's interesting you say that, because another thing that we've been talking to investors a lot about is this idea of tokenization. That's another thing Apollo is focusing a lot on. Investors in Hong Kong in particular seem to be clamoring for tokenized funds tied to private assets. Can you do it? Can you do it quickly? Are there concerns?
There's a lot of discussion about that. You're absolutely right. It's a big trend both in Hong Kong and in Singapore. The big, large private banks are talking about how to do this. Primarily, they want to be able to provide a better service to their underlying customer. They want to reduce costs, and they want to fractionalize interests. And you would hope that with fractionalized interests, you should be able to provide a little bit better liquidity than the underlying liquidity of the asset.
So it's a go.
It's an experiment so far.
We will keep an eye on that. When you think about the amount of dollars that are coming into Apollo these days, where's most of it coming from the region?
So we have a very large private or high net worth business that's coming mostly from Hong Kong, Singapore, and we recently made a big hire in Japan. We'll be massively expanding that team over the next year. It's still coming from the big sovereign wealth funds, and it's really coming from the insurance companies now too. The insurance companies are probably 4 or 5 years behind where the US companies are in embracing private investment grade assets. In part because private investment grade assets really exist in scale for investors in the US. And so a lot of the insurance companies are now looking to benefit from that excess return per unit of risk that you can get from investment grade private credit.
So then what is the next frontier? To the extent that you have that paper that you're trying to fill out at Apollo on what your biggest growth area is for the next 2 to 3 years, what is it?
Look, certainly high net worth and accessing retail consumers is one of the biggest opportunity sets out here. And that's both in high net worth, and that's partnering with traditional asset managers to blend some privates and publics in the same wrapper. The Australian superannuation system will be a massive opportunity for us. That system will be the second largest pension system in the world by 2030. It's all been designed for accumulation. They're going to need to start thinking about decumulation. Our retirement services business and safe yield offerings fit in nicely there. And then accessing the Japanese saver, that $7.4 trillion of deposits, the $2 trillion insurance industry, the $2 trillion of household investments. It is ripe for what we provide, and we have to figure out how to more effectively engage with the consumer, but those are the big 3 opportunities.
It seems to be a big megatrend. I promised you at least one curveball. Do you think that the US can replicate the annuation system that is in Australia to any degree? That seems to be the holy grail.
We have a version of it with the 401k system. But I don't think that the U.S. will be able to, at this point, replicate what the Australians have done with the superannuation system. It was 30 years in the making of what they've been able to do.
You got to start somewhere, Matt. It's great to have you. It's only the tip of the iceberg. We're looking forward to what you do in Asia, of course, just a little over 3 years in.
A little over 3 years in.
Thank you so very much.
Please welcome to the stage Divij Chopra, Managing Director and Head, Family Office and Ultra High Net Worth, Waterfield Advisors. Gautami Gavankar, President, Kotak Mahindra Bank Limited, and Sunil Rohakale, Co-founder, CEO and Managing Director, ASK asset and wealth management. For a conversation with Bloomberg's Jeanette Rodriguez.
Ladies and gentlemen, thank you very much for joining us today. And to all my panelists, thank you very much for making the flight from India to Hong Kong. Very exciting times across the wealth management space in Asia, massive market, obviously. India, of course, growing, ready for a quantum jump, so to speak. Sunil, if I may start with you. You've been observing the market and, in fact, participating for over 3 decades now. How have you seen the Indian market evolve so far?
Yeah, I think India is getting even excited and very excited day by day. As they say, AI is a moment. Indian economy is a moment for the world at large. It is going to be the world's growth engine. And if you look at India, the key structural changes which actually make India really a talk of the town is Indians have started understanding how to invest their savings. India is a savings economy. India is actually 27-28% of the GDP is the savings. Indians have traditionally been investing into real assets and gold, which has dramatically changed. And that has changed to that extent where Indian individuals, Indian HNIs, ultra HNIs, and the Indian diaspora become the largest contingent in the last 5 years in Indian capital market. At ASK, we believe sun, moon, and after that we only believe data. So I would like to give data because data doesn't lie. Look at the market. Indian market has moved from 1.2 trillion US dollar to 5 trillion US dollar in the last 10 years time. The resultant output is the mutual fund, which is very retail portfolio, has actually had moved from 120 billion US dollar to 800 billion US dollar, which is like 6x, and it's grown at 20%. Within the mutual fund, if you look at the equities, which has actually moved from 60 billion US dollar to 360 billion US dollar, which is again 6x in the last 10 years time. And the most interesting is the alternative investment fund, the private market, has moved from barely 3 billion US dollar to 160 billion US dollar. This is like a massive private investing growth India has seen. And I think this all indicates that Indian economy and Indian consumer actually have got asset allocation right. And that's where the India story actually has been, is actually doing what it is reflecting into Indian economy, because Indian economy, which is growing at 10-11% nominal GDP growth, 7% real growth, 4% inflation, 10-11% nominal growth, the asset and wealth management industry is actually growing double the size of the nominal GDP growth of the country. So last 10 years actually have been given to the regulators to bring in the regulation which is probably friendlier for investment. It is friendlier to the investors for protection point of view. It is more transparent and disclosure focused, which is the need for any investor, with local or global. And I think that shift is structural shift. The last one, the financialization of saving, is what India story is all about. We have $1 billion customers plus having bank account, and as small as 20-cent transaction without any cost, you can do it from a mobile to other person or other vendor, which actually has changed the whole India's way of transacting with each other, investing with each other. The most important here, and just to give you one more data point, whatever Visa does, the transaction for the year, India's unified payment system does it in 1 month. You can understand the scale of financialization of savings, which means a lot to the India for consumption, for investment, and for lifestyle. That's the change we have seen.
Thank you, Sunil. Gautami, if I could turn to you at this point, indeed massive financialization happening on an interoperable digitization platform. But the Indian market is also very fragmented. You have the main hubs, Delhi, of course, Bombay, but you're seeing massive growth coming from the tier 1, tier 2 cities, the smaller cities, so to speak. You also have a massive pool of HNIs growing there. That's really the biggest growth opportunity in the country. How does a firm really build scale in India to realize the potential of that very fragmented but very large market?
Good morning, everybody. I wanted to tell you first that I represent Kotak Mahindra Bank, which is the third largest private sector bank in India. Otherwise, the context will not be clear. We cater to retail customers, wholesale banking customers, so corporates, and then also to the high net worth, ultra high net worth individual customers. Because we are a banking platform, we are able to cater to the entire length and breadth customers in India. To answer your question, Janet, most importantly, we have a branch presence across India because of the banking network, and thus we are able to cater to tier 2 and tier 3, that is the next in level cities in India. But what becomes most important for us is, are we going to be able to build enough branches across the country to be able to reach? The answer probably is no, because you will have a cost implication because of that. So what we have done is for the retail customers, and I'm bringing that point because it becomes relevant here. For the retail customers, we have created technology platforms where an ability to onboard on the banking platform is done digitally, an ability to invest through our technology platform is done digitally. So the involvement of a human element to that extent is reduced, and thus very critical to achieve scale. And scale can only be achieved if you are using technology by your side. So that's our retail strategy. We feel that this segment is going to exponentially grow as well in India, as we heard from Sunil, the kind of numbers that we are looking at. Then you come to the private banking or the UHNI segment that we all deal with. Now this segment again is growing exponentially because of the fact that one, there are a lot of IPOs which are coming up. Second, because there's a lot of sales which are happening of India Inc. And that happens because you have reached immense valuations and you want to cash out. It also happens because of the generational shift which is happening in India and probably in any country. You see the next generation is not necessarily interested in running the businesses which their parents or their grandparents created. And thus you see a lot of sale of businesses which happen, and thus the growth in the wealth segment is again big. For that segment, we are very clear it's going to be a model which is a combination of tech and human intervention. If I am speaking to our ultra high net worth individuals, he's not going to be extremely happy looking at the reports that we submit on a mobile app. He will need interactions. And this is an assumption or a belief that he will need interactions. We have to go to the levels that AI is going to probably question all our jobs, okay? But having said that, with innovation, with proper products that we kind of curate for these set of clients, by ensuring that we are able to add value by intervention of a human angle in it, we are trying to use both the models, the digital model and the human model, to ensure that we are able to reach the customers at length. The strategy that we have created, Janet, at Kotak is we've segmentized our clients. Became very important because each client needs basis their segments are very different. So today as we speak, we have a professional segment which caters to the professional clients, chartered accountants, lawyers, doctors, which are growing a lot in India. The ultra high net worth individuals segment and the high net worth individual segments. Additionally, we also have a segment which is called the non-resident Indian segment. We see a lot of interest of people who have left India 2 decades back or 3 decades back, living in US, Canada, UAE, Singapore, Hong Kong, who are interested in Indian markets, who understand the Indian markets, who have families and friends in India who make tons of money in the Indian markets. And thus the interest that is there in India is humongous. We know of ASK here who have funds set up outside India to get money into India. We have Kotak funds set out outside India to get money into India. So this segment is again growing. So we are looking at it segment-wise to ensure that we have products which will cater to every segment, and we make a seamless entry into India for NRIs and people in India. We are trying to segment and create niche practices for catering to each segment.
Thank you, Gautami. Divij. Gautami, of course, massive wealth management services with Kotak. You have a very influential advisory service. And you speak to all of the client ranges really that Gautami spoke about, both in India and outside. What are the key questions that your clients are asking you? What are the problems they're trying to solve within the Indian market?
Yes, absolutely. And I think for a context, so I work with a boutique investment advisory firm. So our main client base is in the HNI and the ultra high net worth segment. I predominantly look after the latter as well as family offices. So again, very high touch segment. The landscape that has been very well articulated by Sunil in terms of the macro and the structural changes that you're seeing in India is something that we're facing. And we see a big shift away from, tier 1 cities, the major metros, Delhi, Bombay, as you alluded to, remain extremely important, but there is a big development of wealth that's happening all across the country. Tier 2 cities, tier 3 cities, and for us it's a very exciting opportunity. The questions that we see families coming to us with, irrespective of where they're from, and as you know, within the high net worth and the ultra high net worth segment, there is a commonality in terms of problem statements that they come to us with. The way Indian wealth management has been historically distributed across to clients remains very fragmented. So most clients come to us having multiple wealth managers. And so the first problem that they want to solve for is truly understanding what their overall exposure is, being able to see and manage their risk a little bit better. So even something as simple as help us with our MIS and our consolidated reporting. That's a starting point. Secondly, a lot of the families are also multi-generational. And with that comes very different kind of solutions that you have to kind of solve for. Here we're talking about transference of wealth from one generation to the other. In more established multi-generational business families, you would go so far as helping them in terms of setting up structures for succession planning, estate planning, but then also coming into helping create more of a framework, a governance system, a family governance or a family constitution, so that they have certain rules of engagement in which they can operate on. And these families also, whether it's tier 1, tier 2, you're seeing them also becoming more multi-jurisdictional. You have families where children may go overseas, they stay on, they go to college over there, decide that they want to spend a little bit more time overseas, maybe not necessarily be part of the business. And with that, it leaves for different problems or challenges that need to be solved for the clients, because different jurisdictions come with different regulatory nuances that have to be solved for. Toughest, obviously, is if a client's child goes and settles in the US. The kind of planning that we have to do there is very different. But multi-jurisdictional families in terms of the own family construct, as well as now how families are wanting to also develop global allocations as part of their portfolio. And India has predominantly, we have very strict capital controls, but there are enough solutions that are there that the government has approved, which allow us to have conversations to actually start helping clients also develop overseas allocations. This is part of a portfolio diversification tool. It's a currency diversification, and the global markets play a very important aspect. Further to Gautami's point, we also see a two-way flow. So you have Indian clients who are keen to invest overseas, but one of the reasons we're all over here is there's so much interest from offshore, not only the NRI community, and the Indian diaspora, but also global investors who are looking how to access India, and how to access India in the right way, with the right partner, make sure that governance is there, transparency is there. So we are also seeing a lot of interest inbound as well that we work to solve for. Another problem that families often talk about, the Indian wealth management industry has been predominantly, as I mentioned at the start, distribution-led, which means the solutions that are given to investors across are driven by product commissions. And today, 58% of the wealth management industry is actually through this distribution model, and only 14% is on advisory. If you look at the US is only 2% in terms of distribution, and almost 60% in terms of advisory. And there is, over the last 5 to 6 years, I've really seen an increase in terms of financial literacy with the clients that we're speaking to, who are demanding more transparency, who are wanting to get into conversations where they know that there is more of an alignment of interest. And this is also a big shift that we're seeing, especially as you go higher up the client value chain. So in the HNI and the ultra HNI segment, this is something that we're definitely seeing them demand of their service providers. And that's at Waterfield, that's all we've ever done for the last 14 years. We're a pure play advisory firm, and I think that's why we've been able to resonate so well with this particular segment of clients.
Divij, I want to turn to Gautami with something that you alluded to about the government giving opportunities and putting in place structures. There are, of course, capital controls in India in terms of how much families can take outside the country. But there are also opportunities within the country in terms of we have a national infrastructure pipeline with trillions of dollars worth of projects. We have a massive digitization push happening in the country. Prime Minister Modi's goal, of course, is to make the country a developed country by 2047. Gautami, what are you telling your clients? Where are the opportunities existing in this market to really channel wealth in? And at the same time, what are the obstacles that they could face within the Indian landscape?
So quickly, we in Kotak look at the trend which Divij was explaining. We call it Globe to India, where global people are interested in India, and India to Globe. Let's not forget the India to Globe leg, because of capital control regulations, is restricted. So per financial year, an Indian resident can take out only $250,000 US. Is that a big sum of money? Not at all. If you have a listed company promoter in India whose kids are in US and wanting to settle in US, it will take, so after the death of the patriarch, one can take out $1 million US. So if there's 100 million, it will take 100 years for the wealth to go out. So that's the kind of restriction that we have in India. So to answer Janet's question, a lot of families are looking at how they can take the wealth outside India, especially because their second generation is outside India, and for diversification. So two-pronged strategies, diversification, at least we tell our clients that 20% of their wealth could be diversified in another currency, and dollar is the currency that we talk about. And second is because the second or the third generations does not want to run the businesses, wants to go out of India, how does this capital go? I think some other countries will have the same problems and the same situations faced by some of you while advising your clients. When it comes to India again, traditionally, it has been equities and debts, and all of us three here will agree on that. But when equity markets are doing very well, alternates come up. Alternates have been the flavor in 2007-8 before the crisis. We, in fact, launched an art fund way back in 2006-7 because you wanted alternative ways to invest. Okay. Were we mature enough in 2006 to understand the art fund? Question mark. But alternates get a space, and so is the case in India now. There's a lot of interest in alternate assets. Now we also see a lot of interest in private credits, So you see a lot of funds which are set up by international managers in India doing private credit business. So that's something which is gaining a lot of traction. You see a lot of real estate play through structures like REITs and InvITs. Okay? You have a lot of private equity and real estate funds again, where you are able to participate in a pre-IPO situation, or again a private credit situation, or a infrastructure fund, or special situations which are sourced by the fund manager in a company, like a demerger, like a merger, like a big acquisition, and you know that the valuations of the company will go up. So you acquire some of these companies in your fund. So you see a lot of growth in all these asset classes. Most importantly, as I was talking about India to globe, and I explained about the restriction which exists, we also have something which is called GIFT City, which has been established under the guidance of Prime Minister Narendra Modi. That GIFT City enables an Indian HNI who has a entity, maybe LLP or a partnership or a company, basically in any form a business entity. You are entitled to take out 50% of the net worth of that company to be deployed in global funds. That's a huge market which we see, or a huge trend that we see, and we see thus a lot of foreign banks and fund houses wanting to capture this market. We have always seen MNC banks like HSBC, Standard Chartered being in India, and they are increasing their presence now. But we've seen JB and LGT also having private banking presence in India. And that itself shows that the way the landscape is growing, people want to participate in the India growth story. And lastly, one point which Divij mentioned, models like advisory, distribution, where people make, where the wealth manager make commissions, are prevalent. But you also see multi-family office models which are coming up, because you need to cater to not just the investment requirements, but the overall holistic requirement of a HNI client, be it succession planning, be it family business succession, be it simple restructuring of their companies, be it philanthropy, be it concierge, be it anything which a HNI or a UHNI family will want to do.
Sunil, we are now down to less than 10 minutes left in the conversation. So I want to ask you about these product ranges that we have. Gautami mentioned alternates is a massively growing space within the Indian market. And of course, ASK, backed by Blackstone, is really big into the alternate space. What kind of product innovation are you really seeing in the Indian market that's an opportunity for clients?
Absolutely. I think at ASK in 2022, when we thought of doing the transaction corporate action with Blackstone, and we realized that diversification of assets of the HNIs, ultra HNIs and family offices is the key. We were more pivoted to the public equity long only investing style, which is the most important style in India, and which generates significant alpha, because India is still an alpha market, though at the same time we can't miss the beta part of the market as well, correct? And the passive and active are the new styles which are going to come in. But when we interacted with Blackstone as a whole, and we realized that Indian HNIs and ultra HNIs are now getting diversification as one of the key theme in their portfolios, we thought of creating an alternate investment vertical. And that vertical primarily focused on private market focused, which is private credit, which is the most important part of the growth driver Indian economy would require, because banks and non-banks have their regulatory constraint in structuring those kind of credit transactions, which probably gives us significant opportunity for the alternate investment funds to do the private credit business. Second part is the real assets business, which is a private equity real estate business, whether it's a high yield credit, whether it's a performing credit, whether it's a private equity. I think all these three, because Indians understand real estate well, and they are in a way over allocated to equities, real estate as asset class, but investment into real estate, where underlying is real estate, understands them the most. So I think that is also one area which is done quite well. We diversified apart from private credit and real assets business to hedge solutions business. And in HNIs and ultra HNIs, to get into a long short absolute return funds, index plus funds, and the market neutral strategies is something which is completely new to the Indian market. The size of that market probably is increasing exponentially, and we clearly thought that that is one area we should get into, and we are seeing the reciprocation happening. So in terms of asset allocation, we need to create product and services which probably our ultra HNIs, families are diversifying into, and that's what we did in alternate investment side. Private equity is also another interesting area which we would explore at some point of time, but then you have to choose the path. Either you are early stage, you are mid-market, or you are going to be the M&A or acquisition. I think that space we have yet not explored at ASK, but Blackstone obviously is quite large in M&A space. That actually helps us in diversifying our client portfolios.
A lot of innovation clearly happening in India, a lot of asks from the clients for product diversification. Divij, do you think India prices risk adequately? Has the market really been tested amid all of these products and demand coming in?
I think it's a very relevant question, especially when you're seeing the valuations today. And in terms of the risks that India face, I would first start off with a positive, and that even in the current backdrop of geopolitical risk and trade uncertainty, the current growth as well as market momentum remains very strong in India. But I think it's also very important to clarify that resilience does not necessarily mean you're immune. And to this effect, if you look at the construct of even our equity indices, about 16 to 17% of ownership in terms of market cap is still through foreign owners. And if we continue to see, if we see sustained outflows from foreign investors, that has an impact on market sentiment. It has an impact on price action. And even though we have a very robust domestic demand that keeps a lot of liquidity continuously coming into the market, it's something that still can have an impact in terms of what we see in the markets per se. The second point is that today Indian equities still trade at a 20 to 30% premium over the emerging market peers, as well as historical averages. This, on the plus side, is a testament to the perception on the opportunities, the structural opportunities that lie ahead. But there is always that risk also of mean reversion. And that would happen if you have a consistent set of follow-on risks in terms of our growth drivers that we associate. For example, weaker public capital expenditure, lower urban consumption, and you also see, as I mentioned, geopolitical risks, market turmoil. That would lead to a higher chance of mean reversion. And we do see a few risks on the horizon. If global political, geopolitical tensions continue, we have geopolitical tensions that are also a lot closer to home, that one has to also be cognizant of. We are susceptible to a certain extent to commodity price volatility. Rupee depreciation can also have an impact. And these are things that we have to keep in mind, even as portfolio managers, that portfolios have to be almost all weather. You have to also look to bring in proper risk management into the tools. But India is exposed to risk. We are very resilient, but that does not mean we can't be impacted.
Well, Divij, one of the panels this morning was, of course, trading in an environment where there's chaos.
Yeah.
And India, of course, is right at the heart of chaos. Arguably, this is a country that has dealt with chaos through the decades. But in the final closing moments of our panel, I want to ask all three of you a question with the request that we keep it to a succinct one-sentence answer. And the question is this: every day, all of us wake up to a different world. In India, we go to bed. There's always a tweet, a Truth Social post coming out from the US. The world is different when we wake up. So very succinct answer. 3 years down the line, I'm not going long. I'm not Prime Minister Modi, I'm not President Xi Jinping, I'm going only 3 years. 3 years down the line, when we're having a similar conversation, what kind of Indian market will we be speaking about? Sunil, if I could start with you.
Sure. So I know that one line I will give you, but I'll borrow 2 lines for that. Financial risk, economic risk, both India stacks up so well, and that is all self-mitigated by virtue of India's own positioning, and I'll not go into details. The geopolitical risk is the only risk which actually currently, so the risk is going to be coming from outside into the Indian market and not really. India is now 4th largest, and here is my prediction for the next 3 years. If we happens to meet after 3 years, India will be decisively a 3rd largest economy in the world. Today we are 4th largest. So in 3 year time, we will surpass Germany's economy as well. Yeah.
Gautami.
So quickly, our brand campaign is a sentence called "Hausla hai to ho jayega." You all will not understand this because it's Hindi, but have the courage to dream big. That's our campaign for the Indians, the aspirational Indians that we are dealing with. And we think, and I believe in what Sunil said, that we should be the 3rd largest growing economy, and the interest will remain there. One small comment. I'm wearing a sari, and on the sari you see cycles. When I come next after 3 years, I'll have an autonomous aircraft, a fighter aircraft, speeding with growth and success.
Divij, same question to you. No cycles on your suit, unfortunately.
No cycles, unfortunately. Not any that you can see anyway. One setup to my point that I want to make is I spent 25 years outside of India, predominantly across Asia and Europe. And for me to move back 3 years ago, it was on the professional aspect where I just see a tremendous opportunity of wealth creation across the country. It's very entrepreneurial. The landscape has already been set in terms of the structural numbers. And our RBI governor has captured a philosophy which I think is the most apt way to finish this off. He said this in DC recently, is India is not an investment destination. We are your partner in prosperity. And that's where I see us continuing to remain in 3 years.
Well, India shouldn't be the market between you and your break. A massive growth opportunity, a massively exciting space in a world of volatility. Thank you, ladies and gentlemen, for your attention. To my speakers, thank you, Sunil. Gautami, thank you as always. Divij, thank you very much. Thank you.
Thank you.
Can you grow your wealth anywhere, anytime, without the right partner? Imagine expanding your business to Dubai, marhaba, while setting up a family office in Hong Kong and investing in Singapore. Standard Chartered's unique global network, deep local insights give you unparalleled expertise anywhere right now. Now is your time for wealth.
Please welcome to the stage Nicolas Rigawa, Global Head, Capital Market Products and Solutions, and Country Head for Singapore at Standard Chartered.
Hi, good afternoon, everyone. My topic today is the growth of structured product in Asian wealth management. Why is it even a topic? Why should you pay attention? Well, there's no publicly available information, but I think one can estimate that today structured product represent between 20 and 30% of the revenue of any wealth shop in Asia on investment product, including insurance, right? That's doubled probably over 5 years. That's quadrupled over the past 10 years, right? So what explains this success? The word of structured product is broad. You can apply many perspectives, but I believe that fundamentally the root of success is in the fact that structured product offer formulaic outcomes. What that means is that if you get the view right, you will get the return, right? That's very important. structured products are used to achieve essentially two things. One thing is to access assets and markets that would otherwise not be accessible. The other thing is to customize distribution of returns for investor. And so there's a huge universe of payoff that achieve participation, that achieve income, that achieve more complex outcomes as well, such as dispersion of or outperformance. So that's one way to look at it. Another way, which is sometimes overlooked, is to look at the variety of wrappers, the delivery mechanism, the legal delivery mechanism that decide what can be sold to whom and how, right? There's, looking at Asia, there's many jurisdictions and there are very diverse approach to how those products are regulated. But if you take Hong Kong as an example, I can count at least 5 different structured product delivery wrappers, right? So what has changed, right? Why the relevance has increased so much over the past 10 years? Well, I would say we've witnessed a complete technological revolution. With the entry of platforms, structured products today are completely platform managed, and that has done 2 things. The first thing is that it's decentralized, the ability to price and execute away from execution desk into the hands of relationship managers. The second thing that is done is that it's allowed the reduction of minimum issuance size and led to ultra customization of products for our investors. That, by the way, has massive infrastructure and technological implication that I think we will probably all facing. On the back of that, what we're now seeing is that banks are starting to invest in DIY platforms where clients themselves can design and execute their own structured product. Will clients self-help? At the moment, fair to say, I mean, we've invested ourselves. It remains relatively marginal. But will they self-help? How do we take them on that journey towards self-helping? That's a billion-dollar question. Now, looking back 10 years, the market forces have also shaped the product offering. Pre-COVID, in an ultra-low interest rate environment, 99% of the products were capital at risk and equity-linked. In 2022, with inflation, with the rate reset, we saw a complete swing the other way, and 70% of the product became principal protected. In 23-24, things swung back, and we probably, at the end of 2024, sat at around 30% principal protected, 70% capital at risk. And so we entered 2025 thinking that the industry stress tested, we're ready for anything, right? But now, how is life under the Trump administration for a structured product practitioner? I would say it's been extremely eventful. A lot of us have grown a lot more gray hair. But the clients, I think the clients, they, after a very eventful month of April, I think they've integrated the new reality. They understand the new equation. And I would say they broadly divide into 2 camps. Some of the clients are going to want to wait it out safely, and they will look at the whole array of principal protected products. At the other end of the spectrum, we are seeing some clients play the Trump put that was discussed this morning by Steve and Jean very, very actively. Looking at the industry, I do believe that we have the tools, we have the maturity, we have the risk management framework to be able to deliver those solutions to our clients safely. And so I would say that in conclusion, I feel that, yes, you should continue to pay attention to the increased relevance of structured product because quite likely it's here to stay, stress tested, and able to weather a very broad array of market conditions. Thank you for your attention.
Please welcome to the stage Fannie Wurtz, Head of Distribution and Wealth Division, ETF and Indexing Business Lines, and Chair of Asia, Amundi, for a conversation with Bloomberg's Diana Lee.
Well, sitting here.
Good morning, everyone. My name is Diana Lee. I'm an Asia Wealth reporter with Bloomberg. I cover billionaires and family offices in the region. And we're honored to have Fannie with us today. She is a key leader at Amundi, where she serves as the chair of Asia and head of the distribution and wealth division, ETF, and indexing business lines. So that brings us a wealth of experience to the panel today. So welcome, Fannie. I would love to start with something of a global investment landscape. And this whole morning, we keep hearing over and over again on this concept of US exceptionalism and whether that's kind of over. So as Europe's largest asset manager, I'm curious, what are you hearing from your clients and how do you see that playing out in the rest of 2025?
First of all, I'm very delighted to be with you here. And obviously, the music this morning has been about diversification and all of the questions that you raised. When we discuss with all of our clients all around the world, most of them are kind of cautious nowadays, exactly for the purpose and the questions we all discussed this morning, and notably linked to the uncertainty of the US policy. When they say cautious, they are cautious obviously about US assets to wait for more clarity, and also a bit cautious about all of the markets that are very much dependent on who can be significantly affected by US tariffs. For now, we are starting to see some relocation, even though it's a bit too early to confirm a definitive trend. But what is striking is that we are actually seeing a structural shift, and this is what has been discussed as well this morning, is the need for greater diversification in portfolio. What has been also discussed this morning, and this is something we are hearing from all of our clients, is how they can diversify as well from the dollar, which didn't play so far its role as safeguard or risk-free assets. And actually, in one of the panels this morning, 2 of your respondents say, can we consider dollar as a risk-free asset? They say maybe, maybe not moving forward. So all in all the discussion we're having with our clients is how can we help them and what will be a key diversifications towards their portfolio moving forward.
And where does that leave other major markets like Europe and Asia? What are you seeing in terms of like the fund flows?
Yeah, actually, exactly to your point, we are seeing 3 major themes nowadays into the client's portfolio. At first, we do believe that we are in a pivotal moment for Europe, obviously. Even though the growth potential are still modest, there are some catalysts that are playing their role and that are currently in place. Everyone is speaking and actually witnessing and expecting increased spending into the defense sectors. There's been as well some fiscal push in Germany, and obviously ECB will be supportive in terms of liquidity. All of that should also play and be in favor of a re-rating about European equities. And if we want to turn it into practically into what we are observing in terms of flows, and if we take the ETF market as a proxy and short-term reallocation of potential flows, this year's flows into the UCITS market, which is European and international investors, are 4 times higher into European equities than US equities. So actually, we're seeing some kind of shift into the allocation. The second, actually, and to that point, last year, it was 10 times the opposite, 10 times higher flows into US equity, whereas to European equities. The second, actually, themes that we are actually hearing, and that has been a key topic this morning as well, is that a lot of our clients are finding appealing stories in Asia, actually. Obviously, because Asia play a crucial role into the global supply chain. There are sentiment and flows that are improving. There might be good earnings surprise. Asia rates offer good value relative terms to other, I will say, currencies. Asian central banks will be positioned to potentially cut rates. And obviously, we are seeing it as well in terms of flows, whereas this year, the flows toward emerging and also Asian equities are as high as in US equity into UCITS markets. So it's kind of a reverse trend. And the last one, obviously, and that has been as well discussed this morning, is definitely gold. Gold has performed very well. There's been some demand for central banks, and gold actually is playing a role as a hedge and safeguard assets to any client's portfolios.
Yeah, and shifting to Asia, it's a very diverse and dynamic region. We just had 2 panels on India and Japan, which seems to be gaining a lot of attraction these days. So which geographic location or asset class do you see in Asia that's more promising?
If you look at Asia ETF markets, actually the growth has always been driven by, I will say, 3 factors. Obviously, there is regulatory reforms coming into place into many markets. There is obviously a demographic shift. Actually, we all agree that the growth is here and actually witnessing the growth everywhere in all markets in Asia. And obviously, there is a rise of digital distribution and actually digitalization, which enable a mass, I will say, adoption of savings from clients. Usually, when there is an ETF acceleration, there needs to be two factors which are currently putting in place into Asia. At first, we need the development of tax incentivized schemes, which are actually taking place. And second, obviously, they need to have regulatory support. So if we take some true example into Asia, obviously Japan has been witnessing an expansion with the NISA scheme. In Hong Kong, there is a great momentum with the eMPF and the ETF Connect. In South Asia, and notably Singapore, we see a rise of digital actually actors moving fast, and there is already a big retirement scheme in place. Taiwan are changing rules for active ETFs. So all of that are creating actually very good conditions for broader, I will say, growth of the markets. And this should encourage, obviously, retail investments and long-term savings flows, which will benefit to, obviously, passive and ETF as well.
Any expansion plans for Amundi in those places?
Well, actually, I mean, we are the largest European UCITS provider and manage 400 billion. So obviously, we are witnessing and monitoring all of those developments with any of our local teams and accompanying our clients once they want to get ready or exposed to those markets. Yeah.
Gotcha. I want to shift to the private markets because it's something that's been on a lot of conversations among ultra high net worths in this region. Have you seen any change in terms of how the wealthy investors in this region view private allocation?
Yeah, when we look about private markets, actually, and ultra high net worth, so I will say private individual, the allocation is still very small. It's less than 5% of their overall portfolio, and it estimates to represent roughly $2 trillion today. But the adoption is getting actually growing and accelerating, and we expect that amount or that percentage of 2% or 2 trillion to triple over the next few years. There is actually, private markets are appealing for ultra high or private clients for many reasons. The first one is that in a low risk environment, obviously there is a need for new sources of yields and obviously for diversification in portfolios. But that is also, I will say, supported by a strong demand, actually. Corporates need ongoing financing and refinancing, and the bank are less, I will say, present in the sub-investment grade lending businesses. And so all in all, what we see, to your point and to your question about where the demand is evolving, is that ultra high net worth has been historically focusing into single strategy or willing to get exposed to, I will say, single strategy to diversification and return. But we see more and more demand for multi-manager or fund of fund, and notably to evergreen product, which enable either private banking clients or mass affluent clients to get exposed to a full diversified private markets portfolio. One point of attention is that we should focus obviously on the liquidity, we should focus on the suitability for clients, and that will require an enormous amount of financial education if we want to make sure we get the right investor protection.
Yeah. And this is something for our audiences that come from mainland China, because I know Amundi has a big wealth management business there. So have you noticed any change in terms of risk appetite among wealthy Chinese investors? And well, how does that reflect their product preferences, for example?
Yeah, obviously the Chinese market is a fascinating market and very dynamic market. And actually we have long-term commitment at Amundi towards China. Out of the ongoing conversation we're having with our clients in China, and obviously on the back of year-to-date volatility, we see China wealth clients being currently very cautious. Cautious means that their allocation to fixed income is the mainstream of their allocation, but they are also looking for high dividend and notably stable return products. The second actually effect is obviously they are looking for diversification, and they are looking as well to offshore product just to get a bit of higher return, and once again to diversify the currency risk nowadays.
Mm-hmm. And in terms of their global diversification, it's a tough time for them. There's so much geopolitical uncertainty. There's US-China trade tensions that are still kind of going on. So which other international markets might they want to diversify their money into?
Well, actually, it comes back to the initial discussion. There are, I will say, three big themes that we are witnessing into, I will say, our conversation with our clients locally on the ground. obviously, they start to see initial interest into European equities, even though still not, I would say, confirmed nowadays. There is obviously strong appetite for gold that has been performing very well for the last 2 years. And actually, we cannot ignore neither the DeepSeek moments and obviously the strong demand for tech and notably China tech stocks, given the context.
Yeah, and in terms of maybe their allocation to private markets, is there any specific products that they might prefer?
You know, like in general, private clients' adoptions to private markets is requesting, you know, a lot of financial education and also making sure about the suitability of the product and notably the illiquidity of the product towards the allocation and the model portfolio of each client requesting long-term allocation. And this is where obviously discussing with lots of, I will say, wealth manager, evergreen solution might be best fitted towards a kind of more broader adoption.
Mm-hmm. I'm also curious about crypto. This is something that I heard a lot of family offices here wanted to add more exposure, but haven't done so. Have you seen any innovation in the crypto ETF space here?
Obviously, crypto has been gathering a lot of media attention about the previous months, and obviously crypto as well has been meeting some of the demand of special group of investors and mostly the younger generation. We do believe that if we were to see a bigger or I'll say broader adoption, there still needs to be an harmonized, globalized regulatory framework about it, and still the industry has to get rid with some of the concern about the security of the assets deposited and as well about all of their, I will say, healthy value chains to be done. Okay. So all in all, I think the more the markets will mature and regulatory will jump in, the more actually the adoption and the broader adoption will be.
Mm-hmm. We have 2 minutes left, so one last question on the technology side. So this is something not just reshaping the wealth management industry, but also the financial industry as a whole. Especially in Asia, we've seen a lot of AI innovations recently. So how do you see that changing the way we work every day, and how do you adapt?
Well, it's a big question, and actually this is fascinating. Whenever we look at the asset and wealth, there is a massive transformation that is getting on the way. And coming later to your point on digitalization, the first massive transformation is the demographic shift. And we are seeing actually 70 trillion of wealth that is currently transitioning from baby boomer to the X, Y, and Z generation. And obviously this generation is much more tech savvy and actually tech friendly. So they act differently, they need deeper sophistication and integration. And this is where obviously this is shifting all of the business model from wealth management to adopt more technology. The banks are adopting technology to get actually much more mass affluent and retail, and obviously to capture the needs and the needs of those, I will say, younger generation. And on the other way around, all of the digital tech platforms are also upgrading them skills to be able to tackle the needs of much more wealthy clients to get upstream into wealth offering. Meaning that all of our industry actually has to capture and to make sure adapting to that wealth or digital technology challenges. For banks and wealth managers to enhance their, I would say, tools with their portfolio management or risk management, obviously to offer a greater client experience and then satisfaction, and obviously to be better efficient whenever they deploy any investment solutions towards their clients. So all in all, very positive developments for their industry.
Yeah, that wraps up our conversation perfectly. Thank you so much again, Fannie. And it's time for lunch now, so everybody please head out to the foyer and enjoy our buffet. And if you cannot find extra space, we have extra seating at the Garden Cafe. And if you're going to the Invesco lunch, please head to the 7th floor on the Chatham room. Thank you so much for coming again, and enjoy the rest of the day. Thank you.